Dupasky as well. So we keep an eye on that. And we have Merck looking to buy Springworks in cash as well. So there's 3 to watch. Let's get to the open.
Yeah. This is Maersk, which could be the trade story. Let's talk a little bit about what is happening with the market open. The opening trade is upon us. Let's show you some numbers. The FTSE 100 is absolutely flat as a pancake. No movement there. We're expecting it to be open 1/2%. It's not exactly a convincing open, and it feels like a very cautious market this morning. There's a series of kind of catalysts out there. Which one you latch onto, which narrative defines this market this morning, I think is really hard to tell. So the stock 600 is up by 0.2%. The DAX clearly has got no news going on this morning. It is up by 0.4%. If there's any news in the German market, usually takes a few more minutes to open. The IBEX is up by 0.3%. The CAC 40 in Paris is open by 0.4%. We await the Swiss to complete the deck this morning. But basically what you're getting is a, relative to recent market movements, cautious start. Europe is not doing much this morning. Got a slightly negative but improving picture on US futures. Asia was mixed as well. Market doesn't know what this week is going to deliver. That is the signal we're taking, maybe from the early trade, Lizzie. What are you seeing in the sector narrative?
Yeah, at the moment you've got every sector in positive territory on the stock 600. So energy leading the gains, up 0.7%. Food, beverages and tobacco just behind, up 0.5%. And bottom of the basket is basic resources, up 0.2%. Same sort of move for construction and manufacturing. But we'll keep an eye on the broader picture, but I just want to dive back into the single stocks that are moving. So Airbus, off the back of this deal to take over Spirit as part of the Boeing reintegration, is up 1.8%. We were talking about Italian banking. Mediobanca is currently up more than 1%. Merck, on this deal to buy Springworks Therapeutics, is currently down 1.5%. And you'll have to forgive my eyesight, because I thought previously that Merck...
It's very easy to do on the screen.
Clearly, I need a visit to the optician. But Maersk's shares today are down 1.4%, as you might expect, given all of the trade uncertainty.
I'm going later today, so maybe my eyesight tomorrow morning will be improving. Airbus has also been upgraded this morning as well by Kepler Cheuvreux. It's got a price target of 170, so there is also an upgrade-downgrade story that is maybe worth focusing on there as well. In terms of the overall picture, as you say, it is biased very much indeed towards what is happening with the upside this morning. You've got 470 stocks up, you've got 117 down. Novo, ASML, Airbus, LVMH, Shell, Novartis doing all the heavy lifting. So it's interesting to see that we are seeing some of the laggards recently beginning to just come back a little bit and do very nicely. So the breadth is fairly good, but I still think this is a very cautious start to a Monday morning, which in a week that has a lot to deliver potentially, and it's very hard to say which way, which direction ultimately some of the data, some of the news flow is going to take us.
Yeah, perhaps we'll get more direction when those numbers come. But let's get analysis so far on the bigger picture. We can speak to Sophie Hyun, who is portfolio manager and strategist over at BNP Paribas Asset Management. Good to have you back around the table, Sophie. Big picture, if we're past peak tariff, if not peak uncertainty, does US exceptionalism come back somewhere down the line? Future's not suggesting so this morning.
So we think that what we've seen so far is an unwind of US exceptionalism and this Trump euphoria that built up post-US election. We think we could be at peak tariff. We could be also at peak very hawkish narratives, but we're certainly not at peak recession pricing. So that's why we went into tariff with a rather low equity exposure, because we still have down the line a US economic slowdown coming in.
Yeah, I mean, I saw that you've gone underweight US small caps, but aren't those the very companies that would benefit if, you do get those rate cuts from the Fed faster than we're expecting? And we've had actually quite dovish Fed speak from some members over the past week.
I think the problem with that is you could have in the meantime some stagflation fears, which means that the Fed put will be much lower than you think. So it means that risky assets could suffer in the meantime. And what we believe in is we take advantage of the bounce we've seen as of late to basically sell on rallies. And we think that given the US economy is now slowing further, so if you look at the OECD indicator, we're already in slowdown. So we're taking advantage to basically short US small caps to to further expose our portfolio to potentially a recession.
But you think a recession's coming, right?
Yes. So we think that at the moment, if you look at economic surprise indicator or economic changes indicator, so the CT1s, there's a dislocation. So hard data are still resilient. Soft data are pointing to south. And we think that the hard data will basically come down in the coming month and quarter.
What did you make of last week's rally? Like you're using it as an opportunity to sell into. What did you think of that rally? It felt narrow, didn't feel like it was that convincing, felt like maybe it was a little bit technical. Like, what did you make of it? When you watched that rally unfold, was it like, okay, this is what we expected, or this is a surprise? What did you make of the rally?
I think it makes sense. So there's two things. So one thing is, if you look at surveys, or sentiment indicators, so the Bank of America one, now 49% of people think there's going to be a hard landing from 11% last month.
Yeah.
If you look at the AAII bull versus bear, like sentiment indicators are now very, very bearish. But in terms of market pricing, I think we're not there yet. So it makes sense that we have a dead cat bounce, but I don't think it's going to be sustained. And you could basically take advantage to that to gear your portfolio a bit more towards a US economic slowdown.
Yeah, I've also seen that you've been long gold for 2 years.
Yes.
We're down today on gold by 1.25%.
Yeah.
Lots of strategists saying that it's time this rally lost steam. How are you thinking about that? Do you actually see it climbing much further in the weeks to come?
So we had like a super bullish view on that, but our mandate allows us to be a bit more flexible. So if you think about peak tariff and peak extreme narrative from the Trump administration, you would think that in the next month, gold could come down a bit. So that's why we halved our gold exposure over the past 10 days. But medium term, we think that gold is still a good investment opportunity as central banks will continue buying and diversify out of US dollar.
And just while we're on havens, you say that treasuries are going to come back as a cushion eventually. When is that? What does it take?
I think it takes a recession. So that's basically what you said, as in Fed cutting. If you look at the Fed pricing, it doesn't go below 3%. So the market pricing expectations are still above neutral. So you need a sharp US economic slowdown for the Fed to basically cut and for treasuries to play again the role of portfolio hedge.
At the moment, people are trying to, within their equity portfolios, using Europe as a portfolio hedge. It seems to be being perceived as being the antithesis of the United States. You take money out of the States, you put it to work in Europe. Is that just a relative trade? If equities are coming down, is it just that Europe will lose less? Or do you think by the end of this year we could find ourselves in a situation where the US is down and basically Europe has marked time or maybe made some gains here? How are you thinking about the kind of the Europe versus US trade this year in terms of relative performance and absolute performance?
It's a good question. So if you look at the OECD indicator, US in a slowdown already, G20 is still in an expansion. So if you think about world going into a more slowdown mode, it means that down the line, you're going to have lower expected returns. So what it means that the expected returns on equities is going to be less. So what you want to play here is relative value.
Yep.
And we think that Europe could make sense because of defense, infrastructure spending, and the fact that earnings will be relatively protected from that, but also repatriation flows out of US into Europe will keep P expansion a bit more protected than in the US, and that's what we've seen as of late.
But that's still a relative trade. What about absolute? Is it possible for Europe to hold up in a world where the US market is down and down sharply.
But we've seen that it's been happening since January, right? And we think it could continue, but it means that from a portfolio standpoint, the expected return you're going to get from your equity allocation is going to be much less than the past 3 years. So you need to be mindful of that. And that's why you need to basically build a bit more into diversification assets, and China makes sense.
Okay, but what about China then? I mean, aren't you worried that the economic toll from tariffs is going to be just too much to deal with stimulus? And even then, hearing from the Chinese Foreign Ministry over the past couple of days, it doesn't seem like the stimulus is that forthcoming yet.
I think it's not that forthcoming yet because you still have uncertainty on where tariffs are going to land. But the stimulus response, I think, will be dependent on where tariffs are going to land. And then on the other side of things, the strategic industries that the Chinese government are giving a priority to, I think it's going to protect earnings and it's going to make them much more insulated from external shocks. And that's why, if you look at the correlation between Chinese equities and the rest of the world, it's been coming down. So it's basically the portfolio diversifier you want in your portfolio.
The problem is that a lot of investors are really wary. Foreign investors are really wary about putting money into the Chinese market. Is there a situation here where, with enough people worried about it, that market it will struggle? And yes, I can kind of hear the logic of it, but the reality is that people are nervous and therefore flows are being affected.
But I think the nervousness depends on the performance. Like a year ago, no one wanted to touch China. And now the narrative has shifted a bit because there are priorities in consumer demand, they have their strategic industries, they have DeepSeek as well. So we think that the narrative will continue to change. And the fact that the Chinese government will adapt their stimulus response to external shocks. They are the only country able to do fiscal without unleashing inflation. What else do you want?
Well, wouldn't you be safer, instead of buying Chinese equities, to buy things related to the China story? I know that you're long the Aussie dollar and the Kiwi.
Yeah.
Isn't that a safer bet than Chinese equities?
I think Asia as a whole, I think, as a regional allocation will make sense much more than America, let's say. Aussie and Kiwi, in my sense, is more to leverage further US dollar bearishness rather than China exposure.
Sophie, nice to see you.
Thank you.
Really interesting conversation. Sophie Hewen, portfolio manager and strategist at BNP Paribas Asset Management. Talking of China, we've actually got the briefing taking place right now, the Foreign Ministry briefing, I think, taking place. Unsurprisingly, officials there being asked about whether or not there is contact between Xi and Trump. Trump has suggested, certainly in that Time article, that yes, this is happening. China may be pouring a little more cold water on that. There have not been any calls with the United States recently. We are not engaged with trade talks with the United States. That feels fairly black and white to me, fairly certain. We are not talking. There are no conversations happening, certainly not at a senior level.
Yeah, the he said, she said continues.
Yeah.
But what level of officials is Donald Trump talking about is really the question that we'd like to answer.
Well, he was implying it was at the highest level. That seemed to be that he was implying that she had called him. That certainly seems to be being denied quite strenuously by the Chinese officials. Anyway, let's move on and see what effect we're having in the European markets this morning and talk a little bit about the details we're seeing coming through at the centre of the European markets, which basically takes us towards the core six. As you can see, gains this morning. Actually, Novo's up quite nicely. You've also got LVMH up quite nicely as well. But these, relative to recent experience, are not big moves. So the market is gingerly moving higher this morning, cautiously moving higher this morning.
Indeed. Well, we're going to look at what else we have coming up in the week. We've got a lot of European earnings to report on, so we'll take you through those and all the details next. This is Bloomberg.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Monday morning, good morning. Welcome back. You're watching the opening trade. We are 16 minutes into the opening trade. We're starting to climb a little bit. We're seeing a little bit of a pickup coming through. European stocks beginning to climb back a little bit. Asia actually had a fairly decent day. Overnight, though, US futures have been negative. They're beginning to turn a little bit more positive. So a better mood beginning maybe to percolate, but I would add still quite a lot of caution. A lot of things are happening this week. You've got a lot of potential moving parts. And after a decent rally last week, it's going to be harder to maintain the momentum, I suspect, into this week. Lizzie?
Yeah, a lot of it is happening in terms of the individual stories. And so this is an M&A theme emanating this morning out of Europe. And we have Mediobanca shares up 0.7%. It offered to buy Banca Generali. This news this morning is a 6.3 billion euro deal, a surprise takeover bid. And really it's the latest in a wave of potential deals sweeping Italian finance. And you're also seeing Banca Monte dei Paschi shares up as well. They're up 1.9% because remember, Mediobanca itself is a takeover target and it's rejected this bid from Paschi as well. So Italian banking shares up in general this morning, as are Deliveroo shares, a whopping 16.5% off the back of their M&A news too.
Absolutely. So let's talk about Deliveroo. Its stock certainly is moving on the back of the DoorDash bid that we've seen coming through. I think they're looking at 180, so we're still not there yet. That was the price target that has been talked about over the weekend, 180. So we're at 170.90 at the moment. So merger arb, you can argue, maybe signalling not quite a level of 100% level of conviction in this. We've obviously moved up quite sharply, but we're not quite there yet. So it'll be interesting to see exactly what risks are being priced into this deal and why.
Yeah, and Deliveroo down so much since the IPO. Just also given all of the trade news at the moment and the idea that, you know, the US is going to start really feeling the pain and you're seeing such a hold-up in terms of shipping from China to the US. Look at Maersk shares this morning. They're currently down 2.9%. So that stock feeling the pain. Of course, it really is in the crosshairs of all the trade uncertainty.
Let's come back to the M&A theme. Airbus has reached a final agreement to take some of the assets from Spirit Aerosystems. The deal effectively, which has been a long time coming, clears the way for this struggling tier one supplier to the US, to the global aerospace industry. going through. So Boeing basically is taking Spirit back in to Boeing, but the problem is, though, that Spirit also supplies Airbus, so that needed to be spun out. Let's get some details on why this has been so complicated. Benedict Campbell leads our global aviation coverage and joins us now. Benny, just walk us through why this is so significant, why it's been so complicated to deal with Spirit.
Good morning. Yes, as you said, it's a complex deal involving three parties, Airbus on one side, Boeing on the other, and then sort of Spirit in the middle. The reason Boeing is buying Spirit back is because obviously they realized this is a business they couldn't keep standalone. They spun it off in 2005, hoping that Spirit on its own would thrive. The opposite has been the case. This is a company that's really struggled on its own. It didn't have the financial wherewithal, didn't have sort of the financial umbrella of Boeing. And then in the middle of last year, as Boeing went through this deep crisis, they decided, let's buy this back. Where the complexity comes in is that they also make a lot of parts for Airbus. And obviously, Boeing can't just buy back the Airbus parts because Airbus would not be happy with that. So it was a matter of how do we unravel, how do we unpack these different parts of the Spirit operation. And we now have the first part of that with Airbus announcing what they're taking over. Again, sort of the devil's in the details. Airbus is actually being paid to take over these assets. That gives you a sense of just how weak that business is. They're also forwarding $200 million in credit line to sort of help Spirit limp over the finishing line until Boeing actually takes it back. So a problematic but very important business that Airbus is taking parts back of.
So, Benny, where does it leave the supply chain then? How much does it fix the issues here? We know of Boeing's woes, but also you've got all the tariff uncertainty as well. How much does the Spirit deal fix the problem?
Well, it's sort of a first big step, particularly for Boeing to sort of gain control again of this asset. For Airbus, they report earnings on Wednesday, and we'll try and get a sense of what kind of money will they have to invest in these assets. This is a business that has languished for a long time, but it's very crucial. But Airbus will have to significantly pump money into their operations. They make parts for the Airbus A350 wide body, for the A220, the small narrow body, and those are obviously very important programs. So Airbus will have to take a significant chunk of money and reinvest in that business. Boeing, once they announce that deal, their portion of the deal, will have to do the same. So investors will be looking at what will this cost them over a longer period of time to sort of straighten things out. As you said, the supply chain has been sort of in people's minds for ever since COVID, really, and the distress in the supply chain. So it's important to gain greater control over this asset, but it'll cost them.
Benny, just finally, can you just update us on where we sit with tariffs and Airbus and Boeing? We find ourselves in a situation where I think we're kind of waiting to see what happens with Europe. We've got a pretty good idea of how difficult life is with Boeing. But just, you've seen a big share price hit. If you take a look at the longer-term Airbus chart, you can see the hit that's come through as a result of the tariff narrative. How much clarity do we actually have, and how much detail do you think Airbus will be able to provide on Wednesday?
Well, I think on the clarity part, the short answer is zero. We really have no clarity at this point. We heard from Safran last week, a bit of a surprise announcement from the CEO saying, oh, some of the tariffs appear to be off. We heard so overnight. That gives you a sense of just how quickly things seem to be moving back and forth. This is an industry that's lived in a tariff-free environment for the better part of sort of half a century. I think 1979 is when they agreed on a tariff-free world. So this is an industry that struggles with this new environment, with parts moving all over the world, you know, and the Spirit deal today gives a sense of that, just how much these components are made all over the place. Malaysia, Scotland, Belfast, you know, the US, Japan, Italy, they really come from everywhere. So having these walls and these barriers in place is a huge issue. So far, the hit on the share prices hasn't been as pronounced. Partly that is because these are very mobile products, so you can move them around. And if you look at the spat between China and the US, Boeing might say, okay, if China doesn't take my planes, there are enough other customers out there that might. India comes to mind, but also other markets. So on the one hand, the demand is there, but still, this is going to potentially throw a huge wrench into the whole supply chain again, just as a time when it was sort of coming back to life. So that's going to be a problem.
Benny, thanks for joining the dots for us. Bloomberg's Benedict Camel with the latest on the aviation space. He mentioned we're going to get those Airbus earnings on Wednesday. And of course, it is the biggest week for European earnings by market value. It's about to get underway. Some of the continent's largest firms reporting this week. And Bloomberg's Charlie Wells can take us through it all. Charlie.
Lizzie, so it literally is raining earnings this week. We're hearing from some of the biggest companies about how these firms are going to navigate what looks like it could be a choppy year ahead, this trade war emanating out of the United States. And we really have to start with the banking sector because they're really going to kick us off. And the key question here as we enter this week is, does the same pattern that we saw with a lot of Wall Street lenders, does that pattern translate across the Atlantic of this equities trading boost and a deal slump? I think that is a question that's going to be front of mind, or is the narrative changing? And if we focus in on two European banks reporting this week, we've got Deutsche Bank and UBS, and this is a sign that some of that narrative could potentially be shifting. Some of the questions people are asking, we've got so much momentum for Deutsche Bank on the back of that German fiscal spend. We see them really boosted there. But if you think about UBS also reporting later this week, they've got a significant equities trading unit that's very significant, but they are under pressure. Their share price, of course, under pressure this year on the back of questions about regulation, on questions about capital that they face. So some signs of narrative shift, at least here in Europe, compared to what we heard from Wall Street a few weeks ago. Now, if we're thinking about the trade war, we've also got to think about the auto sector, so important for the European economy. This week, we've got Stellantis, we've got VW, we've got Mercedes. And really here, we know that they're subject to these 25% tariffs. That's what we've been talking a lot about. But something else to home in here is on demand in Europe. Now, there are expectations that demand in Europe this year could flatline compared to the year before, hitting the levels that we saw kind of in the years after that GFC. So back in 2012, 2013, that adds yet another headache for these automakers. How do you make your car go? You need energy. We've got the oil majors reporting later this week, rounding out the week. They, of course, have been under pressure on the back of a declining oil price that is going to be in focus in particular, and we will be watching that very carefully.
Okay, Charlie Wells, we thank you taking us through what to expect on the earnings front this week. Today, a bit quieter for earnings, more of a focus on deal making. But Charlie did mention Deutsche being boosted by the fiscal spend in Germany. Yep. And we're getting lots of lines on how the new German coalition is going to be made up.
We're starting to get the details. This has been a trickle. We obviously had the kind of the term sheet being announced in terms of the deal being done to form the new German coalition. This is a phase process. We're now getting kind of the last phase, you could argue, in this process, and that is a naming of some of the other ministers, some of the, you could argue, less key ministers, but still very key ministers. So we now know who's going to be the economy minister. We now know who's going to be the foreign minister. So you've got Katharina Reich is going to be the economy/energy minister, two real key portfolios, and Johann Wadephol is going to be the foreign minister. So some key names coming through as part of that political process. Up next, we're going to talk about another political process. What is happening in Canada? Going to the polls, what does it mean? We're going to find out next. This is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
This is the opening trade. We're 30 minutes into today's session, and actually stocks are on the front foot this morning, doing better than we had expected. You got the stock 600 up about 0.5% at this point. Outperformance from Italy, perhaps because of the M&A news in the banking space, but the CAC and the DAX not far behind it. All but two sectors in the green guy, and banks near the top of the basket.
Let's talk about politics and figure out exactly what is happening there. Canadians are going to the polls today in an early general election. Remember, called by Mark Carney after he was elected leader of the Liberal Party last month. So what can we expect?
Prime Minister Mark Carney, former governor of the Bank of Canada and the Bank of England, leads the Liberal Party into the election after taking office last month.
My government will put into action our plan to build a stronger economy, to create new trading relationships with reliable trading partners.
Carney's rival is Pierre Poilievre, the leader of the Conservative Party. A few months ago, Poilievre was riding high. Polls showed him heading for a landslide victory, potentially securing a two-thirds majority in the House of Commons. But things have changed. Since Carney entered the race, the political landscape in Canada has shifted. Poilievre's lead has evaporated, and both the New Democratic Party and Bloc Québécois have lost ground. If the Liberals don't win a majority, however, they'd need support from the NDP or Bloc Québécois. Complicating matters, U.S. President Donald Trump's aggressive trade policies, particularly new tariffs on Canada, are dominating discourse about the election. On top of that, Trump's suggestions Canada could become the 51st state in the U.S. have drawn more attention than domestic issues, and those comments have changed the political climate. Both Carney and Poilievre have taken a strong stance against Trump's provocative rhetoric and policies.
The president is betraying America's closest friend and attacking our economy, proving once again that Canada must end its era of over-dependence and weakness.
For Canadians, this election is a referendum on their economic future. The outcome could determine how the country addresses these challenges and how it positions itself on the world stage.
Michael Ignatieff is the professor, or a professor, at the Central European University and former leader of the Canadian Liberal Party. Very well qualified to talk about this subject and joins us now. Michael, thank you very much indeed for your time this morning. Is it fair to say this is a single-issue election, that this is the Trump election?
No doubt about it. I think that had Trump not entered our domestic politics and said we should become the 51st state, we'd be having a very different election. We'd be having a change election. The Liberal Party had been in power for 9 years. I'm a liberal. I love my party, but I think it was time for a change. But Trump's interventions have simply shifted the balance entirely. My party was 20 points back in January, and now it's 4 points up, and it's all down to Trump.
In terms of the outcome, therefore, how different will the response to Trump be, depending on who wins?
Interesting. It's an interesting question because, in fact, there's been a great deal of convergence in that clip you just heard. Polyev is suddenly changing his tune. He realizes he sounded much too American in style. He's become much more tough on Trump. In policy terms, both sides of the aisle are converging on a strategy to diversify export, seek new markets, eliminate internal trade barriers, build some infrastructure to tie the country together. All of this stuff is addressing a long-standing productivity challenge that Canada's had. Our productivity is falling behind the states, and we've got to catch up if we want to survive economically. So Trump has been a kind of forcing agent to force the country to come together on an agenda of change. And so whoever wins, there's going to be a lot of action on the economic front, but it does look like Mr. Carney will get the nod in the election tonight.
Michael, good morning. Lizzie here. I wonder, is productivity actually a bigger threat than Trump himself? And when you've got such a fiscal squeeze, and as you say, the two candidates converging, is there really much that either can do to solve that productivity problem?
I think there's plenty they can do. Viewers will be astonished to know that Canada has very substantial internal trade barriers between one province and another. That's got to go. We've got lagging productivity in a whole set of sectors connected with our strengths and resources. The question you're asking is what government can do. Can government do this? There is a risk that government will try and do too much and fail. But there's no question that productivity is the chief challenge. And even if Trump hadn't been on the scene, it would have been our challenge. Trump's presence makes it the salient question for our economic survival as a country.
Well, Polyev is obviously casting himself as the change candidate here, asking the question, why would electing another Liberal fix the productivity problem, especially one who's never held political office before? What's the answer?
Well, Carney's answer is obviously he was in the chair during the Brexit crisis. He showed a very clear and steady hand. He was in the chair during the 2008-2009 meltdown. So he's crisis hardened, crisis experienced, and that's essentially the claim he's making, that if the bad stuff happens, he's the guy you want in the chair, and a lot of Canadians seem to agree with him.
Michael, can Canada become more European? Can it look to Europe maybe as a way of resolving some of the challenges it faces with the United States?
I think Canada has always been more European. We have a much more generous welfare state, much more European-style welfare state than the United States to begin with. We have a lot of historical ties to Europe. But the Atlantic Ocean is a big thing, and 85% of our trade goes down to the States. So I think we will have much closer ties to Europe, possibly developing export of our natural gas and oil to Europe. We don't have any capacity to do that at the moment, but that might develop over the next 10, 15 years. That would be a strong connection between our two continents. But the fact, geography is a stubborn thing. We're next door to the United States, and I think we can reduce our dependence on the United States, but it's going to be a fact of life.
Is there an element of just waiting? Time is also a fairly big factor as well in all of this. Do you think Canada just waits this one out, waits Trump out, or does it have to act in the near term? It has to take a stance at the moment. I'm just wondering how you would be thinking about not just the next few months, but the next few years, and how the relationship is going to change, and whether it's permanently changed between these two countries.
Well, I think, first of all, that we've had some economic challenges, the productivity question, that are problems even if Trump wasn't here, and Trump's made them worse. So we got to fix some stuff at home anyway. And so that has to change. I don't think waiting him out is the right strategy. We've got J.D. Vance just behind, and I think America is changing permanently. I don't think this is just the act of, let me be blunt, a madman. I think this reflects deep discontent in the American heartland at the cost of empire that ordinary Americans have had to pay with an overvalued dollar, imports flooding in, destruction of the industrial base. These are actual facts. Whatever you think about Mr. Trump, he's picking up something in the heartland, and that leads me to think that there's some permanent changes. Any administration that came in after Mr. Trump, whether it's Mr. Vance or the Democrats, will be taking a much more protectionist, mercantilist approach to economic policy, and that forces Canada to change its tune and diversify its markets.
Michael, over the weekend, President Trump told Time that he's really not trolling with these threats to make Canada the 51st state. But, you know, Mark Carney says he doesn't think Trump would use force to do that. Do you?
I take him seriously. I think it would be insanity to send troops. I take him seriously. Do I take him literally? I can't see any American president sending tanks across across the border. I just can't see it. But I can see something else. I can see him engaging in economic warfare over the length of his term as president that would make it so difficult for Canadians to survive that they would begin to migrate south. And then if he blocked the border and prevented migration south, then you might have within Canada a desperate move of people saying, you know, let's amalgamate with the United States because we have no chance to survive as an independent country. I regard that with horror, and I would oppose it. But there are all kinds of ways you can use economic power if he was ruthless enough and determined enough that could bring a much smaller economy, we're a tenth the size of the United States, to its knees. And so you have to take this seriously. He's the president of the United States, after all.
Absolutely. Michael, great to catch up. Thank you very much indeed for your insight. Michael Ignatieff, professor at the Central European University and former leader of the Canadian Liberal Party. Coming up, we're going to turn back to the markets, figure out what is happening there. EM assets bucking the broader weakness since the start of the year. Phoenix Kalan, Global Head of Emerging Market Research at SocGen, is going to be joining us next. This is Bloomberg.
Joe Wolk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
European equities rolling over a little bit. Welcome back. You're watching the opening trade. We're 44 minutes into the session. Little bit of a rollover now, beginning to gather pace. You've still got some fairly big names on the upside, though. SAP's having a good morning. Nova's having a good morning. Airbus doing some heavy lifting. Unit credit tracking a little bit higher as well. So quite an eclectic mix. Earlier on, you probably had a few more stocks on the upside. There's a few fewer now. There's a few more down. But still, definitely, if you're looking at the bias within this market this morning, it is to the upside. So within the stock 600, you've got 421 stocks up, 171 down, 8 unchanged, Lizzie.
So that's what's happening in the stocks picture. In terms of euro dollar, it's flat to the downside this morning. 113 is where we trade. The dollar, on the flip side, slightly stronger this morning. But the bigger picture has been that emerging market assets have been posting these unexpected gains since the start of the Trump administration. You've had local currency bond returns jumping, a gauge of stocks outpacing the S&P 500, and a currency index that's clocked its best rally since 2017. So let's get into this. We've got Phoenix Kalin, Global Head of Emerging Markets Research at Societe Generale, around the table with us. Good morning, Phoenix. Where's the sweet spot for EM here between a US slowdown and a full-blown recession that benefits EM?
It's been very challenging for context for EM in the sense that, it really responds badly when you have global growth shocks, and it really responds badly to high vol. And we've had both. We've had a deterioration in growth expectations. We've had a huge surge in cross-asset vol. And that's really, I think, hindered how much EM could have rallied had it not been for those ingredients, especially when you've got the dollar tanking 10% in the space of a month.
So very simply, bad news for the dollar isn't necessarily good news for EM.
So it used to be, in years past, the historical relationship had been so strong between the dollar and EM. You had like a 1.1 time leverage in EM. Your dollar tanks 1%, EM appreciates 1.1. And now that relation's really collapsed. It's gone down to between 0.3 and 0.4. So despite the dollar tanking 10%, EM's only managed to gain between 3 and 4%. And I think that's down to the high vol, that's down to the poor growth expectations still. And I think until we have a reversal of that, which I think is probably imminent, because now we've got lots of more positive signs coming out within the Trump administration about wanting to make deals, especially with China, wanting them to kind of get to the negotiation table. We can have some of that reversal in terms of better growth expectations and a decline in cross-asset vol.
What do you think the market's signaling about how long we're going to have to wait, though, for that deal with China to get done?
Well, so, China has been just supremely masterful around playing this game, letting the domestic pressures within the U.S. economy apply all that pressure on the U.S. administration, how they've had to reverse so many of their decisions and their tariff policies. And I think, eventually, over the coming months, that's definitely going to bite into the consumer market as well in terms of higher CPI. We haven't seen that yet. We've had so much front-loading behavior so far, so that's yet to come. And so while they wait for those pressures to play out, their leverage is building against the Trump administration. So they have increasing amount of leverage when it comes to negotiations with tariffs. And they've been saying, remove all the unilateral tariffs before we'll talk.
In terms of what comes before a deal with China, we're likely to get deals done with a series of Asian nations. Maybe some of those are going to come quite soon. Scott Besant's been talking about this over the weekend. Those deals are likely to be seen as positive for those countries and by extension, for their currencies. But to a certain extent, you're going to get an offsetting within any deal against China, and China's going to respond to that. Are these deals how do you think these deals will land when they do land with the FX market? Will they be taken as uniformly positive, or will that China concern about how China is going to respond eat into any gains that we are likely to see?
Yeah, I think the concern for especially the Asian trade partners around how China will respond to the terms is going to limit the extent to which they can agree to certain terms with the Trump administration. So I think already there's been a lot of investor sentiment and positioning for some deals to be done, especially with Japan, especially with South Korea. And those are viewed as potential blueprints or templates for subsequent deals. But still, I think the scope is going to be relatively limited. And as you say, it's going to be hampered by that sense that China is going to restrict how much their room.
So we have to wait. So we have to wait until we get the umbrella kind of détente deal being done with the US before actually you see the full effects of some of this coming through.
Yes, that is going to be kind of the pièce de résistance between China and US. That's what matters the most, is what kind of tenor is that relationship?
Yeah.
How antagonistic or cooperative is it? And then the Asian trade partners can kind of position themselves around that.
But when it's so hairy in Asia, these 17 nations going for pre-deals, shall we call them, not China, and then you've got to factor in that potential retaliation from China, why not just buy the euro or the Swiss franc? Why go into EM?
Well, and actually, we are seeing a lot of that. We're still seeing lots of safe haven flows. We're seeing lots of diversification away from the dollar, and that does benefit quite very much the Swiss, the euro, gold as well. But I think to some extent, because the U.S. is being viewed increasingly as a risk asset, I don't want to say as an emerging market, but let's say a risk asset, that I think is going to increase the appeal of alternative assets. And we've seen actually outflows for the first time out of EM debt in March, out of local and hard currency debt. And that followed about 8 months of really robust inflows where we had like 30 billion per month going into EM debt, and now there were outflows. I think that pattern is going to reverse because people are going to be a bit more comfortable about the prospect that, okay, we've got still global growth deceleration, we've got central banks trying to front load rate cuts because of their growth concerns, we've got actually less inflation worries, and still the relative rates picture, the real rates picture is very positive in EM. So I think those are still going to encourage inflows back into the EM debt assets.
In some ways, a completely unrelated subject. We saw the meeting in Rome this weekend between President Trump and Zelensky. And how does that play in terms of Central and Eastern Europe from your perspective? If we are going to see some sort of a historic deal being done, if Trump does seem to be changing tack a little bit here, how does that play?
Yeah, I think that's actually helped the CE bloc in terms of their asset valuations, especially over the past week. There's been more of the talk about the peace dividend coming back into the picture. And I think the sense that I think on both sides, Ukraine and Russia, there are lots of reasons why they should negotiate something, a settlement within Trump's term, because after that, it can be much more tricky. So I think Russia has lots of reasons to actually come back to the negotiation table, and Ukraine as well. They still need U.S. intelligence. They still need lots of military assistance. So I think that the reasons are there, and it seems like Zelensky wants not a bad terms for Ukraine, but he just wants something that's going to be lasting, something that still is realistic, that he can push through Parliament. So I think all of those reasons point toward a potential deal coming into fruition over the coming months.
It's great to see you.
Yeah.
And that plays into
and that's going to be beneficial for kind of reducing the risk premia in CE currencies and assets and improving the inflows into those markets.
Great to see you. Thanks for talking about us. Phoenix Kellen, Global Head of Emerging Markets Research, joining us from SocGen. Just want to come back to the China story, which I think is fascinating, and Val's here, so we can kind of kick this around a little bit. Temu, we've seen it with Shein already this morning announcing, what was the number you were talking about? 377?
On kitchen towels.
On kitchen towels. So kitchen towels, there's going to be a lot of those floating around in the rest of the world. Temu is talking about sending all of the tariff through, the effect through, which is going to effectively double some prices of the products that it sends. And these are hundreds of thousands of packages every day that are arriving into the United States, affecting consumers. So I'm just wondering how quickly some of the tariff effect is going to show up at people's doorsteps, at the store, and the effect of that starts to manifest itself in the way that the administration looks at how it proceeds from here.
Yeah, because Temu and Shein are the ones who've benefited from the de minimis exemption, and this is the mass market. This is the voter who's getting these products delivered to their door. So this is going to be highly unpopular with the voter, and Trump will be well aware of that, although at the moment he's saying we're not feeling the inflation impact of tariffs yet.
Yeah, in fact, it's time to cut rates. OK, so let's talk a little bit about how we are going to be perceiving all of this in terms of the effects of the economy. It's been a subject that's been talked about a great deal over the weekend. We're still trying to gauge exactly kind of where we are in the process and how bad it's going to be. Val's been crunching the numbers and joins us now.
Look, I've been trying to piece together some sort of timeline of if we do get empty shelves in the U.S., how long is it going to take? And I think many people were trying to crunch over this over the weekend. I found Apollo put together a great note together showing just how we could be waiting possibly until June until all this happens. We have seen the first round effects already beginning. The container departures from China have already started to drop around 40 to 60%, depending on which index you're looking. Now, the next step in that is U.S. port activity slowing, but that could be another 3 or so weeks. It takes around 30 days for a container ship to go from China to the U.S. The next step in that is domestic U.S. trucking, railway, that kind of activity declining. And then it could be possibly not until June, maybe late June, that we end up seeing this, all of this, supply chain ruffles turning into empty shelves for the U.S. consumer. So the net is we could be waiting quite a while for a clear picture of how corporates are dealing with these tariffs.
Val smiles bullishly.
Always.
But the fifth step on the end of that surely has to be job cuts.
Exactly.
So when does that start showing?
Exactly. And Lizzie, I think that's what this all really boils down to. Will the average U.S. corporate be reacting to these tariffs by minimizing their labor force and letting employees go? That's going to be what this really does boil down to. That's going to be what reduces economists' call for 2025 GDP. So that is again focusing us even more on jobless claims on the NFP this Friday, because the worry is that the corporates could be making these decisions sooner rather than later. I know, Guy, that you've talked about the fact that what corporates learned from COVID is don't let your employees go until you have to.
But this time around, could that be different?
Could it be different? And I think that's a big question.
Also, are they going to be telling us? The supply chain story takes a while to work through, but they will know now, so the visibility will start to be showing. So it'd be interesting to see what guidance is on some of these areas. And we're also going to be getting ISM manufacturing coming through Friday. There's an inventory component within that as well, which could be quite interesting to watch too, and see what's happening there.
Most Valerie Titel, we thank you for that look ahead. We've got plenty more coming up on the week in the docket. We've got US GDP coming out later in the week on Wednesday. On the macro front, on the earnings front, big week. We've got US bank earnings as well, and European bank earnings, I should say, and US tech, Meta and Microsoft reporting on Wednesday.
I think it's 4 of the Mag 7 report numbers this week, so that's going to be really interesting to watch. Does the rally get sustained if they produce good numbers? What is happening with the banking story here in Europe? I think it's interesting. You're going to get the automakers as well producing, giving us numbers as well. We've already had some of those, so that's going to be really interesting to watch out for. Plus, Airbus out on Wednesday.
Your fave.
My favourite subject. We're going to watch that very, very carefully. So, yeah, it's a massive week coming up in terms of what we're going to learn. And I suspect it's a very cautious start. You look at the AVAT function on your Bloomberg this morning, quite light volume on European equities. Now, it's been quite high recently, but quite light volume this Monday morning. We're waiting and watching. Anyway, that's it for this show. The Pulse is up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
China promises more support for exporters as data suggests cargo shipments have fallen by as much as 60% since the U.S. imposed 145% tariffs on Chinese goods. Banca Generali shares soar after a surprise takeover bid by Mediobanca in what could be a defensive move against its own takeover by Monte Paschi. Plus, voting set to begin in Canada following an election campaign shaped by Donald Trump's tariffs and his calls to make Canada the 51st state. So there's quite a lot going on. It's a busy week, actually, in terms of data out of the U.S. So we'll have a lot of Fed speakers, FOMC, definitely left, right, and center. The topic du jour when it comes to any moves on yields. Now, look, overall, it's very clear that Trump's China tariffs set to unleash the supply shock as we have some of the data coming from the U.S. economy. I'm looking at S&P futures, they're down 0.3%. Look at the 10-year actually yield in the U.S. at 4.25, and then gold, something that we watch out as a diversification away maybe from treasuries. Gold at 3,287. Now, European markets, this is a picture overall. Again, we had quite a volatile week last week. We're in the middle also of earnings season. So look, European stocks rose some 0.5% overall. You can see the FTSE's gained 0.3%. The CAC 40 gained some 0.4%. Economic data, investors also watching for any signs of progress when it comes to these trade negotiations. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Chinese officials have vowed to provide more support for exporters affected by Donald Trump's tariffs. The move showing greater urgency to shore up the crucial sector as signs of distress emerge. Now, let's get more with Bloomberg's Jill Dices in Hong Kong. Jill, so what more do we know about China's latest policies to support the economy?
Well, so really at this point, Francine, what we're seeing is some more this idea of providing more targeted loan support for a lot of these exporters that are affected by these tariffs, sort of this idea of boosting domestic consumption. So it seems like what these Chinese officials ultimately have in mind is that they need to figure out a way to offset the impact from the Trump tariffs, obviously. And so whether that comes in the form of, figuring out other ways to shore up how these exporters are doing, try to figure out how to, boost their ability, to provide supply to those within China domestically. That's kind of the idea here. The thing that I would caution, though, Francine, about some of these measures that we heard out of China today is that that while there's a little bit more detail in there, a lot of this does seem a bit reiterative. So ultimately, it's not like it's some giant stimulus boost that China is providing to its exporters. It does kind of show that they're at least kind of holding steady when it comes to that sort of support. But again, I think, as you were highlighting at the top of this program, when, we're looking at the amount in which exporters are really kind of losing out when you're seeing that, the amount of shipments going to the United States has fallen so dramatically, it does kind of highlight that the American consumer is certainly going to start feeling the pinch here. And it does highlight that, at least from the China side, there's some measures of support, but they're still being, a little bit measured in terms of how they ultimately are watching the situation unfold. Obviously, and we still have to see whether or not there's any kind of deal between the U.S. and China when it comes to maybe negotiating down the rates of those tariffs sometime in the future.
Jill, meanwhile, there's a lot of course, tensions between the U.S. and China over the Panama Canal, and that really appears to be worsening. Can you unpack the latest?
Yeah, so really, Francine, I think a couple of key details on this unfolding incident that, you kind of want to look out for starting from the weekend. Now, as we know, Trump has really made kind of reclaiming the Panama Canal, this idea of reclaiming the Panama Canal, really central to the first few months of his administration, continues to bring it up. He's lately, suggesting this idea, that the U.S. should be able to sort of pass freely through the Panama Canal. A lot of this kind of comes down to the fact that a couple of those ports within the canal are owned by a Hong Kong-based company, CK Hutchison. That company had earlier agreed to sell those ports to a company, a group that's backed by the American investment firm BlackRock. The latest here, though, is that China's market regulator is actually looking into that deal to kind of see whether or not they want that to go forward. China has been very unhappy with this company, for the prospect of selling off of these ports, and so that continues to be kind of a central point of tension, particularly as we see, Trump kind of, revving back up and, bringing a lot of his thoughts about the Panama Canal, this idea of potentially reclaiming that kind of back into focus. So you do see, again, there's obviously lots of points of tension in the U.S.-China relationship, but this is just one more that kind of shows how that continues to simmer there, particularly against the backdrop of all of these tariffs and the fact that we still haven't really gotten a whole lot of clarity on what exactly, this relationship on trade and all of these other issues is going to ultimately look like going forward.
Jill, thank you so much. As always, Jill Desis there with the very latest on China. Now, cargo shipments from China to the U.S. have plummeted since, of course, Donald Trump raised levies on China. Now, Bloomberg found the number of ships headed to the U.S. is down 40% from early April. The president believes a trade deal with Beijing is still possible.
They want to make a deal, obviously. Right now, they're not doing business with us. People talk about going cold turkey with China, meaning just forget about it. We were losing hundreds of billions of dollars a year with China, and now they're not doing any business with us, not because of them, because of me. Because at 145%, you can't do business. But something's going to happen that's going to be positive.
Well, let's bring in Brendan Murray, who leads Bloomberg's trade coverage. Also here with us, Demos Vitakis, Global Head of FX Strategy and EM Macro Strategy at Barclays. So thank you both for joining us. Another Monday, another trade conversation. Demos, everything's moving basically onto the fact that also China's saying, look, it's not in trade talks with the U.S. So optimism from the U.S. and China kind of pouring cold water on it. What's the market thinking?
I think the market is quite skewed at the moment. The market is assessing the damage to the U.S., the damage to the U.S. consumer, the damage to the U.S. credibility, while it thinks that ultimately China can work through its problems through stimulus one way or another, or find some way of striking some kind of a deal. I tend to think that conversation is a little bit skewed. I think the market doesn't think of the long-term issues that are starting to emerge for China on this count, basically.
Brendan, where are we on the negotiations? Are there negotiations? I know there's always been differing accounts from both parties, but it feels like we're really far apart.
Yeah, it depends on who you listen to from the administration or from the Chinese side. There very well could be some low-level back-channeling discussions going on. But in terms of anything substantive that would lay out a blueprint for talks, that doesn't appear to be happening based on the sources that we talk to. I think what you're seeing in the Chinese shipping data is essentially the rubber hits the road here. You talk about 145% tariffs for the past several weeks. those ships, American importers are not doing business with China anymore because it's more than twice as expensive. So they've canceled these orders, or they've looked out, try to go elsewhere, Thailand, Vietnam, to try to get around those tariffs. And what we're seeing now is the impact of that initial wave of decoupling that will continue to happen if those tariffs don't come down.
Themos, I mean, again, we have, a lot of earnings that kind of look at the U.S. trade policy impact. We also have 4 of the Magnificent 7 tech companies due to report earnings this week. But you see tension in treasuries. I mean, there's really no part of the market that's been spared. Is this crunch time? This week we're getting data where maybe the Trump administration understands to what extent the damage has been done.
Maybe, yes, maybe it's a little bit early. Maybe, we're going to get to see it over the next couple of months. After all, maximum impact in our forecast is probably going to be around Q3. But I would say that, this cuts both ways. The market is convinced that this is the end of the U.S. investment kind of a trade. If earnings keep coming in at a high level, and that's, a possibility, particularly for the Magnificent 7, then, it could shake some of the logic for the market that is in a disinvestment mode from the U.S.
What happens to dollar?
I don't think that the dollar is on a permanent depreciation path from here. I think the dollar is going to be weak for the time being, maybe around 115 in our forecast for the time being. But I think that the market is very, very short the dollar. He's very convinced that this is the end of U.S. exceptionalism. And at the end of the day, if you strip this down to its core, this is a shock where most forecasters are estimating it's a 50 to 100 base points hit to inflation and something like a 1% hit to GDP, one-off, and then we move on. And a lot of the companies also in the higher brackets of capitalization are unlikely to be super affected by it. So that can cause some rethink in a market that is very much one way.
Bern, I mean, holistically, where's the Trump administration actually on tariffs? We have, stories day in, day out of U.S. shoppers also paying for, some of the tariffs because, for example, Temu is doubling some of the prices. We're seeing similar amounts from Shein. We see the president's popularity go down. Has there been a shift in language on what they want to do for trade?
Yeah, it sounds like they're really, the clock is ticking, really, to get some of these trade deals done. The president and his advisors have talked about Japan, Korea, India being sort of on the fast track. If the Trump administration can deliver some of those in the next several weeks, or agreements in principle to keep discussions going that bring some of those reciprocal tariffs down ahead of the deadline, July 8th. Then there could be some clarity that the strategy that has been quite confusing and disruptive until now, might be able to see the light at the end of the tunnel to where the Trump administration is going. If not, and a lot of people believe that trade deals take a long time, they're complicated, and they don't get done in a couple of weeks, then we're looking at a more prolonged period of disruption. Consumers are going to start to feel it. The Fed is going to have to start taking it more into account as something other than a one-time shock to the economy.
Themos, do you think there's any permanent damage from the trade war and the unpredictability of U.S. policy despite a possible turnaround? So, when you look at U.S. assets, will it change this year?
Yeah. No, I think that if we continue on a place where, it's very unpredictable, it's very disruptive, it's very... it comes out without any kind of logic to it, to the policy, then yes, over time there's going to be erosion and damage. But in the here and now, we get very mixed messages from different kind of asset allocators. There are some who are concerned, there are some who are not fazed by this. I would also add that ultimately, it seems that we're moving towards a place where these policies start to make a little bit more sense, in the sense that, a lot of the reciprocal tariffs have been pulled back. Between Canada and Mexico, we're working towards a result that enhances the USMCA participation potentially. And we were always thinking that China would be the ultimate confrontation stage for the U.S. So to some degree, if this starts shaping up in a place where markets can understand it, can quantify it, then I think that things are going to normalize from a different level of asset prices.
Is there a risk premium that you think investors should be attributing to U.S. assets?
Investors are attributing a risk premium to U.S. assets at the moment. I mean, it is quite hefty. You look at the gap between U.S. yields and European yields. You look at euro-dollar versus fair value. You look at the damage to U.S. equities, either in dollar terms or in non-dollar terms this year, valuation adjustments, etc. There has been a pretty significant adjustment. Now, obviously, if we remain on a very volatile policy path, that risk premium could increase. But we're not pricing zero here by no stretch of imagination.
Brendan, what can you tell us about the other 17 key partners that they're negotiating bilaterals with? Again, these take years, but maybe they could speed it up. In certain cases, they already have bilateral agreements.
Yeah, exactly. There's another tack that countries are taking, and that's time is on our side. That the longer we drag this out, the more economic pressure Trump is going to feel. That slow walking this will work to our benefit. We see this with Canada. Now, they are obviously going through an election, and there's the political situation there. But Canada is saying, we don't need to be in a hurry. The UK, it's not going to face a reciprocal tariff increase like a lot of the other countries are, but it's saying we'd rather have a good deal than a fast deal. And the European Union came away from their initial talks with Washington thinking they were more confused than they ever were about what the U.S. wants from the European side. So those look to be on a longer track. Obviously, important trading relationships, as important in some cases as the Asian economies, but those look to be on a much slower pace.
And Demos, how do you play all of this? Again, I don't know how first of all, you play China, but also in terms of currency pairings, is there something to be done with sterling or euro?
I think both make sense, both angles. I think since the beginning, we have taken two main avenues to trade this. The first one is we do think that the damage to China assets, etc., is underpriced. So we have been short renminbi. You can do that versus the dollar or other major currencies. Received rates there and steepeners and so on and so forth. But also, we have been favoring non-cyclical currencies, safe havens, versus cyclical currencies. And at the moment, they both give you an opportunity. Things like the yen, things like the pound, to some degree relative to other cyclical currencies, they have taken a little bit of a pullback, and vice versa. A lot of cyclical currencies, whether it's the Aussie or other kind of cyclical currencies, they sit on a high level, assuming very little cyclical damage globally. So being short cyclical currencies and long safe havens, there's entry levels even here too.
Okay, thank you both for joining us. Bloomberg's trade czar, Brendan Murray, and Demos Fiotakis, Global Head of FX Strategy at Barclays. Coming up, Banca Generali is the biggest gainer on the Stock 600 after a surprise takeover bid by Mediobanca. We'll dig into the latest potential Italian banking deal next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Mediobanca has launched a surprise takeover for Banca Generali, the wealth management arm of the Italian insurer Generali. Now, it's the latest development in a wave of potential deals sweeping Italy's financial services sector. Well, Mediobanca's bid is seen as a likely defensive move as it fends off takeover interest from Banca Monte dei Paschi. So let's get more now with Chiara Albanese, our Italy bureau chief. Chiara, it's so good to see you. I mean, it's very complicated because there's 1,000,001 shareholders and people wanting to take other people over. It's a very Italian affair. So why has Mediobanca launched this offer for Banca Generali?
Thank you, Francine. As you say, is complicated, and this new deal, this new bid comes just as one in a tangle of deals currently ongoing in Italy. But the short answer to your question is this is a defensive move by the CEO, Alberto Nagel. He is becoming a predator, just not to be prey. And the other deal on the table, which really affects this one and is intersected with this one, is the Mediobanca becoming a target for Banca Monte dei Paschi. So this is where those two deals crossed over.
So how would this strengthen Mediobanca? And again, because of the interlocking bids, what are the consequences of this?
Yes, so this is actually a very good move and a good defense strategy for Mediobanca. It is a good deal for the bank itself. It's not only a defense, because buying Banca Generali, which is a little gem, a wealth manager, would allow at the same time not only Mediobanca to take over a good business in terms of wealth management, which combines very well with its own business, but also to swap out its stake in Generali, the insurance company, which is also subject of several deals. And it is a stake that Mediobanca is not really maximizing in terms of its shareholders, so it allows to maximize and improve its stakeholdings at the same time. So it is part of a wider strategy, but one that could make the little bank, the Mediobanca, which is a name that itself is at the center of a lot of plays, very compact and very well placed.
Chiara, thank you so much. Chiara Albanese there with the very latest, of course, on this Italian possible tie-up. Now, investors will be looking for clues on the impact of tariffs as European automakers report this week. Now, let's also bring Horst Schneider, head of European automotive research at Bank of America. Horst, thank you so much for joining us. It's a big week for earnings. It's a big week for tariffs. It feels like automotive and the automotive sector has been one of the harshest, actually, sectors hit by everything that's been going on over the last 2 months. How do you see this playing out?
Yes, exactly. Auto suffered a lot, even though recently we also saw a nice pullback. So therefore, I think the market is not clear how the situation develops. We have calculated all the tariff impacts in our note beginning of April, and we were pointing out that basically EBIT margins could decline by 2 to 4% in the worst case. So if the tariff situation remains unchanged, could be even worse if also the parts get charged with an additional tariff. That's not yet our assumption, but it seems that the market is not yet fully pricing that in. So therefore, I think the market at the moment wait and see stance and wait for the news flow.
Who's better positioned to actually cope with Trump's tariffs?
Well, those car makers producing in the US or not trading at all with the US. That's a shortish answer I could give. But of course, I mean, in the end, if you are exporting to the US, then all of them going to be affected. It just then depends on what percentage of sales is really generated in the US, what percentage of the imports really, or what percentage of US sales really come from the imports. With that regard, we have flagged that of course, the luxury car makers, they are the most affected. Companies like Porsche, which are generating something like 25% of the sales in the US, Ferrari, Aston Martin, 30% of the sales in the US. But of course, the luxury car makers also have got price power. So therefore, it's a question at the moment, when do the car makers raise the prices? And we have not yet seen these announcements, except from Ferrari.
I mean, we'll have, and I think actually we may speak to the chief executive of Ferrari tomorrow, but when you look at some of the companies that will come out with earnings this week, Porsche, Volvo, Mercedes, Volkswagen, again, they have very different cars. They have very different components in the supply chain. Is there anyone that will actually do better than the others? Is this also going to launch a wave of consolidation amongst European car makers?
Of course, if you look at the production footprints, then clearly BMW is still one of the better positioned companies because they have got the largest global plant in the US, that's in Spartanburg. Nevertheless, also BMW imports vehicles, and the US is not looking at the net trade balance. The US is looking at the gross import figures. So therefore, even those companies producing locally, they are affected. But nevertheless, if I have to put the Germans in order, then I would say still that BMW is rather better positioned. Mercedes is a little bit worse. Volkswagen is kind of in the middle. It depends if also the imports from Mexico get charged with the tariff. A lot of ifs and whens and a lot of questions still. Uncertainty is high. But if you also ask me what kind of guidance revisions we could see at Q1, I think a lot of companies even not warn yet on the guidance because they are still in a wait-and-see mode, and they just take the current tariffs and wait for some change. So therefore, I think guidance revisions not going to come for the time being. That's going to take some time.
I mean, even before all of this, the EU is raising, levies on Chinese electric vehicles. How's that working out?
The recent news flow says that the EU works on a compromise with China, that they just agree on kind of minimum prices. So if the Chinese want to sell cars in Europe, then basically that then a minimum price gets charged instead of a tariff. The advantage for the Chinese OEM would be that the tariffs are a cost burden, and the minimum prices mean that the margin that they do in Europe is a little bit higher. Yeah, that could be the compromise, but it's unclear at the moment when that comes, if it comes. I also heard that some minimum import amounts could be set, but yeah, let's see.
Horst, is there a worry that actually the Chinese automakers will come into full force, medium to long term in Europe? And what does that mean for the European market? More competitive and harder for European car makers?
Of course, that's the ambition of the Chinese. I mean, the production capacity that they have got in China is big enough. We know that. The technology that they have is very compelling. I was always saying that the Chinese can offer an EV at something like 50% of the prices that car makers charge here in Europe. The Chinese would not have a problem without tariffs to offer vehicles at a price of kind of 10,000 euros. If you look at the Shanghai Auto Show as well, what innovations have been presented in terms of charging, autonomous driving, etc. They have got the most competitive product, and of course they want to export that product. It's a story that has been written decades ago by Toyota, by Hyundai. They want to repeat that, and they have got the product to repeat that, and that frightens the European Union, of course, and therefore they are establishing some thresholds, but also the Europeans do not get along without Chinese batteries, Chinese parts, for example. So therefore, it's a very tricky question, but long story short, the Chinese, they want to take market share in Europe long term. It maybe takes a bit of time. BYD is establishing local production in Europe in 2026. It's a matter maybe just of a few years.
All right. Horst, thank you so much. Horst Schneider, the head of European Automotive Research at Bank of America. More on tariffs next. This is Bloomberg.
in case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't want to go to rodeo for that. That's
No, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll try it offline.
Don't miss the close, live every weekday.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. China promises more support for exporters as data suggests that cargo shipments have fallen by as much as 60% since the U.S. imposed 145% tariffs on Chinese goods. Shares soar in Banca Generali, the wealth management arm of Italian insurer Generali, after a surprise takeover bid by Mediobanca. Plus, voting set to begin in Canada following an election campaign shaped by Donald Trump's tariffs and his calls to make Canada the 51st state. Now, in other news, Ukraine's president says he's hopeful for a, quote, reliable and lasting peace. That's after he met with President Trump ahead of the funeral of Pope Francis on Saturday.
They have a tough road ahead, okay? And we had a good meeting. It was a nice meeting. It was a beautiful meeting. I'll tell you, it's the nicest office I've ever seen. It was a beautiful, beautiful scene. But he was very, look, he wants to do something good for his country. Thinks he's doing a good job, and he's working hard. We'll see what happens.
Let's get straight to Greg Sullivan, our Russia economy and government editor, who joins us now. Greg, thank you for joining us. Trump met with Zelensky over the weekend. It was an absolutely incredible meeting with incredible pictures coming out of St. Peter's Basilica. Does that bring us any closer to peace talks?
Well, on the one hand, we heard from President Zelensky somewhat of an optimistic note, saying he was hoping for a calm and sustainable peace. We've heard from President Trump that he believes the two sides are close. However, his own Secretary of State, Marco Rubio, sounded a more cautious note over the weekend. He described the upcoming week as critical to the negotiations, but said there is still work to be done. Also, after that meeting with Zelensky, we heard from President Trump on social media. He was actually criticizing Putin, saying that he wondered if he really did want peace or was just stringing him along, and criticized him for missile attacks against Ukraine. Those, of course, have continued throughout the negotiations, with one of the largest airstrikes, the largest airstrike this year, happening just last week against Kyiv. So it does seem that there's still some work to be done ahead.
Greg, North Korea has also confirmed for the first time that it deployed troops to support Russia's war in Ukraine. So what are the implications of this?
Well, yes, it's something that has been long known that North Korea has been supporting Russia's military effort, both with troops in the Kursk region as well as military ordnance. It comes after the two countries signed an agreement on mutual defense support last year. Now, of course, we have both sides saying that, yes, North Korean troops have been involved, acknowledging it, with the Kremlin even thanking North Korea for their help. Both sides do seem to be signaling that this ongoing military cooperation will continue. Another facet of this, of course, is that over the weekend, Russia claimed that it had expelled the final Ukrainian troops from the Kursk region. Ukraine, of course, had been hoping to use that foothold in the Russian Federation as a bargaining chip in negotiations to strengthen their hand. They still deny that the troops have been expelled, but if that does indeed turn out to be the case, that does take away a crucial bargaining chip for the Ukrainians.
Greg, thank you so much. Greg Sullivan there, our Russia economy and government editor. Now, in Canada, a man has been charged with 8 counts of murder after a car rammed into a crowd in Vancouver on Saturday night. 11 people were killed and more than 24 were injured in the attack at a Filipino street festival. Now, the suspect has been named as 30-year-old Kaiji Adamlo. Police say he was known to them and are confident it was not an act of terrorism. Canadian voters head to the polls today after the snap election called last month by the Prime Minister Mark Carney. Now, the Conservative Party, led by Pierre Poilievre, was leading polls by about 20 points was when Justin Trudeau announced his resignation in January. But since then, the race has tightened under the new Liberal leader and economic anxiety over President Trump's tariff war. So we're now joined by Ross Matheson, Bloomberg's EMEA News Director. So, Ross, thank you so much for joining us. Today is voting day, so we won't talk about the polls, but what do we know about the two main candidates?
Well, we do know, obviously, as you were saying, that Mark Carney took over as Prime Minister and as Liberal leader only recently and immediately moved to disassociate himself to some extent from the policies of Justin Trudeau. He rolled back some issues around capital gains tax. He indicated he's open to drilling, to expanding an LNG export terminal. So he's trying to shift himself away from being associated too closely with Justin Trudeau because, of course, Justin Trudeau's policies were unpopular generally with Canadians. We could see the concern about the economy was there well before Donald Trump took office in the US and instigated all these trade tensions with Canada. And so there's fundamental structural issues there for Canadian voters around housing, affordability, the cost of living and immigration. So that's Mark Carney saying, look, I'm a steady hand at the tiller here in difficult times. I've been at Goldman Sachs. I've run central banks. I know how to deal with these complex issues and how to deal with the US. Then you have the Conservative leader, Pierre Poilievre, who's just saying, like, still popular in the western parts of Canada. That's the bedrock of the Conservatives, but has struggled to set out a policy agenda that's quite different and would show what he would do, again, to steer Canada through some very difficult times.
Rosa, has actually President Trump and the tariffs, has that changed all the election?
We can certainly see it's been a factor in the campaign for voters. The question is, on polling day, what does it mean? I mean, for many Canadians, it's this very personal issue in a way. It feels like the US-Canada relationship breaking down for them is a very emotional one, and they see it as a key one for them as a result. But do they vote with that and therefore possibly towards Carney? Or do they vote still on those fundamental bread and butter issues around immigration and so on? And do they look at Mark Carney and say, well, he's not really that different fundamentally from Justin Trudeau? And so that's going to be the question. But, we're expecting, obviously, to see the possibility of Carney winning, and whether that's a majority or minority government is probably going to be the key.
Thank you so much, Ross Matheson, there, of course, our head of the EMEA News Desk. Now, we're also joined by Suzanne Lejeune-Dalgresque, former British High Commissioner to Canada. Ambassador, thank you so much for joining us. So, first of all, what are the conditions you think to restart these talks on the Canada-UK trade deal?
Well, I think this is the moment to do it. And I think one of the things that both sides have to think about is where their fundamental interests are at the moment. And I think from the Canadian side, it has been an issue for many years, decades, that they needed to diversify their trade relationships. They are hugely dependent on the United States. And as you know, the UK was very close to securing a free trade agreement with Canada, and then the talks broke down. Canadians need to look at being proper free traders, I think. Some of their protectionist policies are really damaging to exporters from the UK, for example, for exporting dairy products. And I think they need to look very carefully at now using this opportunity to really tackle some of these fundamental issues.
I mean, the new Canadian government, we understand, no matter who wins, wants to build stronger ties with the UK and Europe. Is there appetite, or how much appetite is there amongst the leaders in Europe?
I think there's huge appetite, and I think Mark Carney already set the stage for that when he came to the UK and to France on his first overseas visit. That was a huge change for a Canadian Prime Minister not to go to the United States. So I think he sent a very clear message at that point. And I think on both sides of the Atlantic, there is a clear recognition that when we can't rely on an unpredictable partner in the United States, we need to look at strengthening those relationships where we do have lasting and dependable partners with whom we can work on some of these fundamental issues, whether it's trade, whether it's defence and security, whether it's immigration issues, across the board climate. We need to look at working with people who at the moment are on the same page as us.
When you look at the Canada-UK trade deal, what do you think are the main sticking points right now?
Well, I pointed to the dairy issue. Canada has a hugely protectionist policy called supply management, which protects their dairy industry. I think that has been throughout all the talks when I was in Canada and remains the sticking point. I think there are also issues about movement of labour, but I think this is the moment to really sit down and bash those out. I think one of the other things is that the Canadians are brilliant trade negotiators, and I don't necessarily think that the UK has always been up to the mark in presenting teams which can really engage at the same level. We relied for many years on being part of the European Union for our trade relationships, and I think this is also a moment for us to look at how we can develop the really high level of trade negotiation skills that we need to have these sorts of conversations as an equal partner.
I mean, the UK Prime Minister is towing this fine line of, trying to support Canada whilst at the same time trying to keep strong ties with Donald Trump, who he doesn't want to upset for fear, I imagine, of retaliation. Does he need to choose between the two?
No, I don't think he does. I think it's quite possible to do both. I think you can very easily have a strong relationship with the United States. And again, it's in both of our interests to keep trade flowing and particularly to have a reasonable and adult political relationship, particularly on the big issues affecting us in terms of geopolitics, Ukraine, the Middle East, and so on. But at the same time, I think it is time to spread our attention and our efforts a bit more widely, and to look at some of these partners who I fear have been a little neglected or taken for granted in the past.
But, Commissioner, what's the right way of Canada dealing with the trade war and dealing with Donald Trump?
Well, I think Canada has some quite strong cards in their pocket that they can use. And the two economies are so closely interrelated that if it completely breaks down, the US will suffer as much as Canada, because cars pass back and forward across the border many times before they're completed. So if that stops working, then it's the US car industry as well that suffers. I also think Canada has some pretty important cards in the energy space, where a lot of electricity and raw materials for energy production come out of Canada and support the US economy. So I think the Canadians can afford to play a little bit hardball on some of these things. And I think what Mark Carney has already done is shown that he's prepared to be strong and shape up to Donald Trump and not allow himself to be backed into a corner.
But if you look at, the threats coming from Donald Trump, does it mean that we'll have an almost new G7 country coming at the forefront of international issues? I know that it was quite significant also to see that decision on Canada increasing defense spending. So how different will Canada look like in 1, 2, 3 years?
Well, I would hope that it will look very different in terms of the role it plays on the international stage. And the Canadians in the past have been a really useful part of the international scene in dealing with some really difficult issues. But if you look back, the last time I think where they significantly played an important part was in the post-genocide period in Rwanda, where Canada really stepped up and played a very, very important role at a terrible moment. Now, we haven't seen a lot of that since. Canada has been very domestically focused, and I think they are a really admired partner. Their values are admired across the world, and I think this is a time where they could step up and really start to play an important role in some of these big issues which are affecting us now.
Thank you so much, Susan Lejeune-Dalgouchek. They're the former British High Commissioner to Canada. Now, coming up, despite today's flurry of offers, the M&A market faces uncertainty as investors navigate tariff risk. We'll be joined by Richard Madden from the investment bank DC Advisory to discuss where we go from here. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Earnings season is here.
European earnings kick into high gear.
Beginning to gather a little bit of momentum.
Bloomberg is first to break the numbers.
Netflix, Hermes,
SAP as well.
ASML reporting a big miss.
With the smartest insights.
Is it possible for the earnings story to dominate?
Look at the resiliency behind the numbers.
Earnings may even flip into negative territory.
The volatility of earnings really matters now.
It's like a marathon of earnings.
Continuing coverage on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is a pulse, and I'm Francine Lacroix here in London. Now, EY Item Club says the UK economy will grow half as quickly as previously expected in 2026 as Donald Trump's sweeping tariffs hit business investment. Now, the influential forecaster has warned that shrinking exports and more subdued household spending will hit the strong pickup in growth previously projected. Now, EY Item Club, which uses the UK Treasury's economic model for its forecast, downgraded its growth prediction for this year from 1% to 0.8%. Now, DoorDash is offering to buy UK-based Deliveroo for $3.6 billion. A filing with the London Stock Exchange shows DoorDash proposing a cash offer for Deliveroo's shares at £1.80 apiece. Now, DoorDash has 2/3 of the restaurant delivery market in the US, and a deal will help it expand into the UK and elsewhere in Europe. Airbus has reached final agreement to take over some assets from Spirit Aerosystems, clearing the way for the struggling U.S. aerospace supplier to be acquired by Boeing. Now, Airbus says it will receive $439 million to take on loss-making facilities that produce parts for the European plane maker. Now, the Airbus deal is a key part of a complex three-way transaction that reunites Boeing with Spirit, an operation that it spun off in 2005. Now let's talk M&A, and market uncertainty is creating challenging times for M&A as deals are being postponed while investors wait for clarity around tariffs and geopolitics. Now joining us now to discuss all of this, Richard Madden, European Executive Chairman at DC Advisory. Richard, thanks so much for joining us. I mean, there's a lot going on M&A, or is there? Because actually when you look at tariffs and some of what the banks are saying, they're pulling off. What are the chiefs saying that PE firms can do and will do?
So it really has slowed down, but it was actually tough before tariffs. If you look at the first quarter of this year, it was down 28% in deal volume on the prior year.
Yeah.
And then a kind of tariff tornado has swept through the market, leaving people really uncertain and really unsure and lacking in any confidence at all.
So what happens next? I mean, how much are investors in PE funds actually complaining about the deal-making drought?
So essentially, what happens next will be driven in part by strategics, and you can see that with the DoorDash Deliveroo deal. But if you look at what's the engine of the market, it's private equity. Because private equity is part of their business model. They buy businesses, they improve them, often by doing more M&A, and then they sell them. So they're drivers of the M&A activity. They were under some pressure to increase that. They're years behind schedule in terms of their realizations and their investments. But now, I just think it's a very brave firm that says, I know the valuation, I know the future, I'll do a deal now.
So, Richard, what does it mean for investors? They move away from PE and invest elsewhere?
So it's slow for them because essentially they make a commitment to PE, and that's a commitment for 10 years. And so you can already see that they're getting a little bit anxious about private equity, and there are fewer funds going into private equity. But what's there is locked there, and therefore there are many years of private equity-driven M&A still to come.
But when you look at the drought, I mean, again, tariffs at some point, we assume, will settle, or will they?
Oh, I hope they do. No, I'm sure that they will, and then people will have a position of confidence. But it will take them a while to feel that confidence. And then again, it takes a while for an M&A deal to happen. It can take 9 to 12 months from the moment you decide to sell and the point at which you sign a deal. And therefore, I think what it means is that M&A activity will be very subdued for this year. If we get some certainty by the summer, then it'll pick up towards the beginning of 2026.
And does that mean hiring, or does that just mean firing at the moment and then maybe picking up when things, pick back up?
I think most people will hold the line because they know that their market will come back. It would be quite brave to say that it's not coming back. So I think for a while people will hold it. If there is a prolonged period of inactivity, then people will have to think about their costs.
Richard, how's fundraising in PE going?
It's been tough. It's been very tough. So, as you say, investors have been looking away because private equity's had 10 really good years, really, really strong growth. But as you look forward, it's not certain that it will be as good. There's quite a lot of fully valued assets in portfolio, which means when they're sold, it'll be disappointing. And therefore, as investors allocate capital, less of it will go to private equity.
If you're a private equity in the US, do you do worse than Europe? Again, do you break it down region by region depending on valuations, but also, I guess, the uncertainty out there?
So the pools of capital are much, much deeper in the US. It is a much, much bigger market. I don't think there's a huge difference. What we have seen is a lot of US funds coming into Europe, not just to invest, but actually setting up their own operations and their own businesses here. I don't think that will be discontinued because people are looking for opportunity wherever they can find it.
Yeah, I mean, Richard, the problem is that people are buying gold. I don't know whether this changes everything, right? I mean, there's so much that investors are asking such a big premium to invest in U.S. assets. Does that filter through also M&A companies, or are they going to get less business if you're a U.S. bank trying to do M&A?
No, I do think there is a continuing perception that Europe is cheaper. And it is true that Europe is cheaper. On any measure, Europe is a cheaper market. But then the prospects for Europe are more challenging. And therefore, I think the market's broadly, relatively fairly and evenly priced. But we'll see.
Okay, is there a sector that looks ripe more than usual? I mean, we've been through a lot of consolidation. The Italian banks, by the way, are absolutely on fire.
Yeah, well, Italian banking is the most extraordinarily fragmented sector, so it's been crying out for consolidation for years and years. So that will take Italian banks and say yes to Italian banks. Elsewhere, I think defence has to be a positive sector where spending will go up. Yeah. And if you look at those big secular changes, healthcare is another, where with an ageing population, you have to believe that those are investments that will pay off over the medium term.
Yeah, the problem with defense is that it's also national security. So how much appetite will there be from regulators or even politicians to let it consolidate?
I think there'll be a lot of domestic-related investment because I agree with you. I think we are now much more aware of the need to protect our national assets.
Yeah, is there, I mean, we had a good conversation last week about the fact that, as trade is redrawn, that means that it's only friendly countries that will do deals together. Does that extend to PE and M&A?
Yeah, I think it does. I mean, I think less so. And I do think people are looking now at Chinese investors more positively than they have been. And there are a significant number of Chinese private equity firms that are showing interest in Europe, and the door is not as closed as it is in the US for them.
What about the UK? Where does the UK sit? M&A, no M&A? PE, no PE?
I think the UK is a very deep market for PE. It's the deepest market in Europe, and the sector is most advanced. In Germany, there are half the volume of deals in PE than there are in the UK, even though it's a much bigger market. So I think the UK continues to be a friendly market for private equity, and The industry has generated a lot of wealth for individuals, wealth for investors, and high-growth companies, and I think that will continue to be the case.
Richard, thank you so much for joining us. Richard Madden there, European Executive Chairman of DC Advisory.
Thank you.
Now, many of Europe's largest banks report first quarter earnings this week with the trade war and market uncertainty in focus. Charlie Wells is here with a preview. Charlie, so away from the Italian banks that have our focus and attention 24 hours a day, what are analysts expecting from lenders this week?
So, Francine, the big question is, do some of the patterns that we saw from these large Wall Street banks, did they translate on this side of the Atlantic as well? Do we get that kind of boost to the trading teams from the volatility? Do we see a deal slow down across these European banks as well? I think if you take a look at Deutsche Bank versus UBS, you see some of these themes, right? Deutsche Bank boosted by this promise of German defense spending, UBS kind of under the cloud of some of that capital uncertainty from Switzerland. So a potential narrative shift here compared to Wall Street.
What were the big surprises last week?
I mean, look, so we've been talking about the trade war, and I think the simplistic take has been if you've got a trade finance unit, if you're exposed to trade, that could spell bad news for you. But actually, BNP reported higher volumes in their trade finance unit than I think a lot of people had expected. And this could speak to this idea that, yes, we are in the midst of a lot of uncertainty on trade, but companies actually need help with this, and that could boost some of these business lines at these banks.
So banking regulation, of course, really emerged as a key theme for this season. And how's that conversation shaping up?
Such a hot topic. So, in recent days, we had some of the CEOs of the largest banks in the UK writing a letter to Chancellor of the Exchequer, Rachel Reeves, saying they want to end ring fencing. They say that this, hurts them on the global stage. That's going to happen in the UK. Meantime, in the US, of course, you've got this pushback on regulation, this hope in the Trump administration that this could finally take center stage. But at the same time, that issue in Switzerland of capital requirements. So it feels like the winds are kind of changing a little bit, and executives are really pushing back on a lot of these regulatory issues.
Charlie, thanks so much. Charlie Wells there with the very latest, of course, on earnings. Now, coming up tomorrow on Bloomberg, our exclusive conversation with the Goldman Sachs chief executive, David Solomon. Catch that interview at 10:30 a.m. London time. We'll be actually in Norway and flying over this afternoon to do that interview. Now, in the meantime, European stocks rising ahead of a week of major earnings, but also major economic data points. Investors really watching for signs of progress in trade negotiations. Now, key companies reporting this week will be scrutinized for earnings impact of U.S. trade policies, and so that could also shift the Fed thinking, or some of the Fed presidents thinking. We also have fresh readings on the American economy that may support hopes of earlier than expected Fed interest rate cuts. And then again, investors just watching out for any sign of progress on the U.S. trade negotiations. At the beginning of the program, we spent quite a lot of time talking about the fact that China said, look, there's no active trade negotiations, which is a different story to what we heard from the Trump administration that also says they've been working on bilateral trade deals with 17 key partners. The Trump administration also saying they're drafting a framework to handle negotiations with about 18 countries in total. Up next, a Bloomberg Brief, and this is Bloomberg.
Is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to
the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. The eye of the storm, the U.S. braces for tariff disruption as cargo shipments from China begin to plunge. A packed week punctuated by jobs data. The Fed's blackout period begins ahead of GDP and non-farm payrolls. And reckoning for the Mag 7 as the cohort posts their worst start to the year since 2022. Microsoft, Apple, Meta, and Amazon all post earnings in the coming days. Well, we've seen an easing of market stress. Can it last? We're weaker on today's future session after on Friday we closed at the highest level since Liberation Day. We're down by about 0.2 for both the NASDAQ and S&P 500 futures. Your Russell 2000 session down by about 0.4%. It is not just earnings we have to cope with. It is also the data. Jobs day comes on Friday, 130,000 expected. PCE, GDP, consumer confidence, all of that comes for this market. At the moment, bonds are posting losses, yields higher by about 30 basis points for your 10-year yield. We are at 426. By the way, we also have a refunding announcement coming from the Treasury this week on Wednesday. So a lot to unpack, but let's look at some stocks moving underneath the surface. Here with that is Bloomberg's Valerie Teitel. Good morning, Valerie.
Good morning, Danny. Let's start with big tech. We're seeing NVIDIA on the back foot in pre-market, falling 1.4%. This comes after, over the weekend, there was a Wall Street Journal report that Huawei is stepping up its capabilities in the chip sector. They are testing a new chip, which would put its capabilities around 2 generations behind NVIDIA's Blackwell chip. So keep an eye on that at the open. Next, let's move on to some M&A activity. We have Merck coming out with a new purchase of a U.S. biotech firm called SpringWorks. This comes as Merck is continuing to put its COVID cash haul to work through M&A activity. Lastly, Danny, let's end with Domino's. Reporting before the bell this morning will be the latest test of consumer appetites. This comes after a competitor, Chipotle, warned of a softening consumer ahead in its sales forecasts.
Valerie, excellent work. We'll catch up with you later in the hour. That's Bloomberg's Valerie Teitel. Also in this hour, we're going to be speaking with Paul Donovan of UBS Global Wealth Management and Kathy Jones of Charles Schwab. So Paul, chief economist at UBS Global Wealth Management, writing today, quote, consumers today are buying goods imported before the oppressive burden of trade taxes. On average, it will take about 3 months for pre-tax inventory to be used. This means economic reality has not penetrated the partisan media bubble around consumers. I'm pleased to say that he joins us now. Paul, it's such an important topic with some data showing that levels plunging as much as 60% in cargo coming from China. So what does it look like when that bubble is pricked?
Well, what we've got really is a two-stage process. So the first thing is that we are going to start to see an impact on people who are employed in the supply chain. If ships aren't coming in, then there's no jobs for truckers, there's no jobs for port workers. That sort of damage is going to become quite evident within, I would say, a couple of weeks. We're going to start to see that. And then after that, we will start to see the price effects coming through. That takes typically up to about 3 months. So that means by June, we will be starting to see consumers facing higher prices in the shops. And when that happens, I think you would get another big hit to consumer sentiment, a big hit to consumer confidence, and Republicans in particular, who've had fairly buoyant consumer sentiment, may then get a negative hit as the inflation starts to show up and their spending power is weakened.
Paul, is it on the same levels of COVID, that is, in terms of both magnitude and stickiness of inflation?
Well, that's a tricky one. I think that there is certainly a clear risk here in terms of the magnitude, that you could be seeing quite sizable increases in inflation rates if the current tariff levels persist. Now, we are expecting some kind of retreat from President Trump. We've already had a series of retreats. They've dialed back on a number of tariffs. We'll probably get some more of that. But you are going to be looking for inflation coming in probably closer to 5% within 6 to 12 months' time. In terms of the stickiness, that depends on how US companies react, because, of course, we are going to have an extreme slowdown in the United States, and that is a disinflation force over the longer term. But if we see US manufacturers raising prices in response to tariffs, using tariffs as a cover for higher prices, if we see retailers engaging in profit-led inflation, then that inflation may last for a longer period of time.
I've got to say, Paul, what we've heard from the companies so far, it seems like a tale of two consumers. From one, you had the banks out of the gate reporting saying the consumer is strong, they're solid, they're spending, likely because they still have jobs. We had a whole lot of consumer companies last week, though, saying that consumers are more value-oriented. Uncertainty is impacting some of the spending. We heard that from Chipotle, for example. Can both of those be correct at the same time?
They can be, because we have to remember we started this year with a really solid foundation for growth in the US and elsewhere. President Trump inherited actually a particularly good consumer economy. Middle-income consumers had low fear of unemployment, they had reasonably high levels of savings, and they had rising real incomes, a combination which meant they were prepared to go out and spend money. Now, what has been happening, it would appear, is that for certain products, consumers, particularly Democrat and independent consumers in the United States, have been front-loading purchases. If you were planning to renovate your kitchen, if you were planning to buy a new car, you bring that spending forwards because you get the sense that trade taxes are coming, as indeed they have. And so that has then added to the strength of first quarter consumption. There's evidence in the data of this taking place. But then, as you've pulled forwards, you're going to get a drop in consumption coming through in the second and third quarter. We already see fear of unemployment, at least as reported in sentiment surveys, is going up. That's another constraint on consumer spending. So the consumer is likely to be a lot more subdued in the next 6 to 9 months.
But Paul, as you very well know and have noted so many times, especially coming out of the COVID period, that you were spot on, that many people didn't see, was don't bet against the hedonism of the American consumer, that they do have an ability to adapt and come back. So are you talking about material weakness that means that you can start to short the spending ability of the American consumer, or does it to some degree continue on with strength?
Well, what we had coming out of the pandemic was consumers had rising real incomes. Now, they didn't always feel that their real incomes were rising. A lot of people thought inflation was higher than it was. But at the end of the month, US consumers had money in their bank accounts, and that was the critical point. Because if an American has got spare cash in their bank accounts, they will go out and spend it. The problem we have now is that Americans may not have spare cash in their bank accounts. Real incomes may start going down now because what we are seeing is rising prices. I mean, effectively, a tariff is a big sales tax increase. That is going to be a negative impact on the ability of consumers to spend, and that's why we have the more subdued outlook coming through. If we add in a fear of unemployment, things become more serious because then consumers become afraid about spending. We didn't have that 4 years ago. That would be the risk this time.
For now, we don't have that. From what we're hearing from companies, Paul, it's more things like downward revisions to earning expectations, maybe a pullback in CapEx and new orders. Inventories, as we've been noting, have been rising before tariffs. How long do you need this current environment, be it uncertainty or high tariffs, that job cuts do start to become part of the story?
Well, the first thing that we're likely to see is not job cuts, but just a freeze on hiring. And that's bad luck if you are a 21-year-old university graduate looking for work, because you're going to find it more difficult to get a job. And that will then add to unemployment. But because you're talking about reduced hiring, not firing, that does not necessarily create the fear of unemployment that would be so troubling. And we're probably already seeing that come through now. That does appear to be the case. To get to actual job losses, well, we will see job losses in certain sectors that are very trade orientated. As I mentioned, if Chinese ships are not coming into US ports, and they're not, that has a very, very quick knock-on effect onto jobs in the trucking industry, in the ports, and so on and so forth. We will start to see layoffs directly coming through there. But in a larger scale, on a scale which is likely to start affecting the unemployment rate, to lead to significant reductions in the payrolls numbers, that's probably still a little way down the line, probably more a second half story that you're going to be seeing that. But once you start to see that, we then need to pay attention to the fear of unemployment, because that's something which changes the behavior of people who have jobs and causes an additional wave of spending reduction.
Paul, this has been an absolute masterclass. Thank you so much for joining us this morning. Paul Donovan of UBS Global Wealth Management. And by the way, we will be getting jobs data coming on Friday, 8:30 a.m., 130,000 expected. Okay, trending on the terminal this morning. Pressure ramps up in the Panama Canal. China is dialing up scrutiny of Hong Kong billionaire Li Ka-shing's plans to sell Panama ports to a group backed by BlackRock. Chinese regulators say the deal can't happen without their approval. At the same time, President Trump is calling for free-of-charge passage for U.S. ships. Elsewhere, President Trump's popularity is sinking. Polls from NBC, CNN, ABC, Fox, and the New York Times, among others, show voters think that he's falling short of his core campaign promise to strengthen the economy. The president marks his 100 days in office on Wednesday. And fast fashion giant Shein hiked prices across products in the U.S. by as much as 377%. Most of the hikes came on Friday. Shein and other e-commerce platforms face a 120% tariff after the U.S. ended the de minimis exemption for small packages coming from China and Hong Kong. Coming up, as we've been discussing, supply shock giant retailers like Walmart and Target have told President Trump that U.S. shoppers could see empty shelves soon. More on that coming up next.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
They want to make a deal, obviously. Right now, they're not doing business with us. You know, people talk about going cold turkey with China, meaning just forget about it. We were losing hundreds of billions of dollars a year with China, and now they're not doing any business with us.
President Trump speaking on Sunday as he made his way back to Washington. Cargo shipments from China to the U.S., according to some reports, have dropped by as much as 60% since early April as tariffs start to bite. For more on a potential supply chain shock, Bloomberg's Brendan Murray joins us now, who leads our global trade coverage. Brendan, just how bad does it look in terms of the ports and the ships coming in? I'm sure you've been tracking all of the flows.
Yeah, exactly. It looks pretty big, the wave or the lack of shipments that are coming across the Pacific. We saw this during the pandemic, the quick shutdown of economies and the quick restart. It causes a lot of disruptions through ports. So what we're seeing are basically American importers canceling orders with their Chinese suppliers, and those shipments, and the ones that are continuing are coming across the ocean now, but the ones that aren't, they're going to places like Thailand, Vietnam, and elsewhere, but they're not enough to make up for the loss of supplies from China. So we're seeing somewhere around mid-May, the ports in Southern California are going to see big drop-offs in arriving cargo. So something on the order of 25–30% is what it looks like right now. So what the retailers are saying is, look, if something doesn't happen soon, these tariffs from Chinese goods aren't lowered, we're gonna face shortages of things, everyday consumer items, heading into the second half of the year, and then you talk about Christmas restocking and that kind of thing. So the longer this plays out, the more painful it's going to be for the real economy.
So it's suspended animation for now, Brendan, as the port shipments hold off as we wait to see if there are any changes. But we did get a change in this de minimis rule in terms of goods under $800 now facing tariffs from China and from Hong Kong. So have we already started to see the price rises come in for some of these cheaper goods for Americans?
Yeah, exactly. So some of the reporting that we have is that Shein and Temu, these online, these e-commerce companies that Americans buy a lot of inexpensive goods from, they are raising prices. They are no longer going to be exempt from a border tax, a tariff, as the Trump administration removes that exemption. So it's some of the prices are going quite high in percentage terms, and that is going to be passed. If you're an American consumer of those products, you're footing the bill for that. So that is a sticker shock on top of the supply shock that's already headed to the U.S.
Brendan, again this morning, overnight, I should say, for American viewers, we had Chinese officials saying we are not talking with the U.S. It's a story that keeps coming, saying that they are not in the midst of negotiations. But it seems like, given policy that's being floated from both China and the U.S., both sides are acutely aware of the pain that consumers might go through. What sort of things are the countries trying to do to relieve some of the burden, as talks still are not happening between the two sides, at least according to China?
Yeah, exactly. There's some reporting today that we have that China is considering some sort of relief for these exporters, the ones that are being hurt by the cancellation of orders to the U.S. So China is positioning itself to provide some sort of cushion to those companies. From the U.S.'s perspective, we heard Donald Trump say over the weekend that there's some sort of income tax relief coming for middle-class Americans by way of the tariffs that he's collecting from American importers. So there is a sense on both sides that the longer this drags out, the longer the two countries have essentially a trade blockade up between the two largest economies, that there will be economic consequences for it, and the governments need to recognize that and perhaps cushion the shock that either one could see.
Brendan, thank you very much for your time this morning. We always appreciate it. Bloomberg's Brendan Murray. Coming up, Huawei gears up to challenge NVIDIA. We have more on the AI race coming up next on your Bloomberg Brief.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what's making headlines around the world and what's on the front pages. The FT has this, that President Trump has stepped up criticism of Russia's Vladimir Putin. Trump questioned whether Putin generally wants to end the war or if sanctions may be needed. Ukrainian President Zelensky said that he's hopeful for a reliable and lasting peace after that meeting one-on-one with President Trump at the Vatican. Next up on the BBC, it's the Canadian elections, and at the start of the year, the Conservatives appeared certain to win any contest by a landslide. That is, until President Trump took office. Now the polls suggest that Mark Carney's Liberals are slightly ahead. The race has tightened in the past week. And the Wall Street Journal having this over the weekend, that Huawei is getting ready to test a new and powerful AI processor to rival NVIDIA. Huawei has approached some Chinese tech companies about testing the feasibility of the new chip, and the development is still at an early stage. Joining us now for more on this is Bloomberg's Mark Bergen. Mark, good morning to you. I mean, it seems like this was inevitable, only a matter of time before Chinese companies and Huawei built their own thing to rival NVIDIA.
Yeah, certainly. I think the leading company out of China to do this would have been Huawei, that they've been working on chips for a long time. The big question here, and the Journal story gets into this, is how much has the Trump administration's sort of choking off a lot of the supply chain for these AI chips, how much is that going to affect Huawei's ability to put out anything that competes with NVIDIA?
I mean, how far behind is China when it comes to things like manufacturing and design capabilities? Are they still far behind, Mark?
My sense from the analysts out there is that they're not nearly as far behind, say, as some would think. I mean, I think that was part of the concern, and at least the rationale from the Trump administration was to choke off this to stop China's advances. We've seen things on the software side from DeepSeek and from Alibaba. We've seen Huawei put out a new smartphone that has actually kind of impressed analysts and much exceeded expectations, and kind of putting out this processor that was a far better performance than expected. And Huawei has consistently done that. But then again, that's before some of these even tighter restrictions and tariffs that have changed everything.
Mark, is the conversation also different because we're at a time when there are concerns about capital expenditures from the big tech giants with what the economy is going to do in America at the same time that China seems to be laying in? Is it not just about the Chinese side, but the American side's ability to continue to spend and invest?
I think it's true. I mean, we saw NVIDIA is now being blocked from China, which the companies put out that would be a $5.5 billion hit from their own market. I think, for what the reporting the Journal has and we've done, Huawei is certainly working with a lot of domestic companies, for everyone from ByteDance, the owner of TikTok, to a lot of its government and state-backed enterprises. I do think there's been a lot of concern about this pullback in data center demand, but in Silicon Valley, the big tech giants, but the companies have consistently said, and we'll see that this week in earnings, that they're actually seeing consistent demand and they can't build fast enough. So I think, this will kind of where the rubber meets the road will be their actual financial reporting.
Yeah, we certainly saw that from Alphabet last week, saying that there's more demand than we have capacity for in our data centers. Mark, thank you so much for joining us this morning. That is Bloomberg's Mark Bergen. And as Mark was mentioning, we do have a busy week of tech earnings. Here's what we got for you. Meta and Microsoft will be reporting on Wednesday. On Thursday, it's Apple and Amazon. Then later in the month, on the 28th of May, it will be NVIDIA. What will they show? It is the worst start to the year for Mag 7 since 2022. Meanwhile, you are looking at equity market futures weaker this morning. It's been wild swings for April. The benchmark at one point was down as much as 14% on the month. Now it's just 1.5% lower this month. By the way, U.S. Treasury Secretary Scott Bessent tweeting about that very fact, so maybe the administration is paying attention to what the market is doing. It's been meaningful swings. The dollar has also stabilized, as have treasuries, but yields do move higher this morning. We are up by 2.5 basis points. 4.26% is where we stand. So it's a busy week of earnings. We're going to get 40% of the market cap of the S&P 500 reporting, the busiest week for earnings by far that we're going to have. What more clues will we get on the consumer? Coming up, we're going to discuss the big weeks. It's not just the earnings, it is also data. We're going to talk with Kathy Jones of Charles Schwab. Coming up, this is Bloomberg.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. The eye of the storm, the U.S. braces for tariff disruption as cargo shipments from China begin to plunge. A packed week punctuated by jobs data. The Fed's blackout period begins ahead of GDP and non-farm payrolls. And reckoning for the Mag 7. The cohort posts their worst start to the year since 2022. Microsoft, Apple, Meta, and Amazon all post earnings in the coming days. The S&P 500, little change this morning, as well as the NASDAQ 100 futures. We are off the lows of this morning. We closed at the highest level since Liberation Day on Friday. So an easing of market stress. Can it last after a huge turnaround in this equity market? It's not just that, it's also a lot of data to come for this equity market and bond market. For now, we're looking at higher yields. Your 2-year yield up 1.8 basis points, your 10-year yield just more than 2 basis points at 4.25% this morning. Let's take a look at what we're going to be expecting this week, because it is a jam-packed one. Here with that is Bloomberg's Valerie Teitel. Hey, Valerie.
Danny, it's a jam-packed week for U.S. economic data. On Tuesday, we get consumer confidence. We also get personal consumption data on Wednesday, alongside the first advanced reading of first quarter GDP for the U.S. Thursday, ISM manufacturing. Any hints of tariff disruption happening in the manufacturing sector? We keep an eye on that data print. Rounding out on Friday with the big one, non-farm payrolls. Will there be any labor market weakness that we can see through this print, dealing with the tariff shock that the U.S. economy is currently going under? It is also going to be a big week for earnings. We get 4 of the Mag 7 to report this week. We get Meta and Microsoft after the bell on Wednesday, Apple and Amazon after the bell on Thursday. But it is a frantic week for earnings reports, Danny. The busiest week of the year for this for the earnings season. We have $20 trillion of market cap of the S&P 500 due to report in the next 5 days.
Oof, that is a lot to take on. Valerie, thank you very much. Bloomberg's Valerie Teitel. And here to help us take it on is Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, so great to see you. How are you thinking about the week ahead? It started out after a quiet weekend, but we're about to get a whole lot of data and a whole lot of earnings.
Yeah, in general, I think this week's data won't be too bad for the economy because it really precedes the imposition, the announcement of tariffs. And so there's a lot of front loading that has gone into the data probably for the first quarter, which we'll get. So the GDP number should reflect some of that front loading of people buying stuff or importing stuff before the imposition of tariffs. And I think the inflation data will be pretty good based on what we saw in the PPI and CPI. The inflation numbers shouldn't be too bad. But I'll really be watching the ISM numbers at the end of the month, end of the week, and of course the jobs data, where we could see some softness.
Kathy, you have said that in the long run, you think Treasury yields are more likely to decline than to rise from current levels. Is that across the curve? Because we have seen some real aversion, especially on the long end, with concerns about where this economy is going and where deficit levels are going.
Yeah, you know, the near-term outlook of the next couple of months, we still look for this sort of broad trading range in the 10-year to persist. So 420-ish on the downside, 440, 445 on the upside. And there is a risk that we get even higher, go back above 4.5% if we get some scary data on the tariff side. But in general, you know, tariffs raise prices, but they also slow growth. And we're already seeing some of that slow growth work its way through the data. So I think the persistence of slower growth, not just here, but globally, will lead yields down. And we're already seeing central banks cut rates in Europe. I think that will eventually catch up in the U.S. and we will see the Fed ease. So it's just a matter of time. And so by year end, yields should be 4% or sub 4%.
Kathy, not that that's any comfort, because of course we don't want any sort of economic slowing, but in April there was this real concern that we saw this dangerous market dynamic starting to brew. That is, yields moving higher, risk selling off, and the dollar weakening. Just given on what you said, does that mean that we're going to return to some sort of normalcy, and that's a kind of emerging market dynamic that we don't need to worry about in the U.S.?
Yeah, I think that that was a temporary move. I mean, we certainly hope so. I think some of that was positioning. You know, we'd gone in, people positioned for continued strength in the dollar, and were surprised when things changed suddenly. And I think that that move really was a reassessment of the outlook for the U.S. economy going forward, and that pulled the dollar down. So it unwound some of these positions, and now probably back to a more normal relationship. It could be that there's a higher risk premium, a higher term premium going forward. We've seen it expand now for several months. I think that the term premium is set higher now because we do have these deficits and we do have all this turmoil in policy and uncertainty about what's going to happen with policy going forward. But I don't think that that necessarily means we're going to have the emerging markets type dynamic in the U.S. You know, we still have the world's reserve currency. None of that's changed. People still need U.S. Treasuries. And I think at yields pushing 4.5%, in the 10-year, you'll find people willing to take on U.S. Treasuries.
So we don't have the emerging market dynamic. It's not necessarily a shock. It's not a financial crisis. It's not necessarily a recession. But Kathy, do we continue to have a slow grind of a deterioration in the attractiveness of U.S. assets, be it both treasuries or the dollar?
I think we do, in the sense that, look, the dollar was on a 10, 12-year bull run that has, peaked in 2022, and it's gradually coming down. There's room for it to come down. And I do think that policy making being so fraught right now with uncertainty and so fraught with conflicting goals, that there'll be less attractiveness for the U.S. You'll see people reallocate elsewhere. But that's not necessarily a crisis. Coming from a huge, very, very high level of the dollar and working your way down to something that's probably closer to fair value, that probably is going to be the case. But I don't think that we're in a world of, everyone moving away suddenly from U.S. assets. I mean, we're still the largest economy in the world. We still have a very dynamic economy, slowing, but still dynamic. A lot of development that's very exciting will pull in assets. But I think, we've peaked, but it doesn't mean that, it's going down at a rapid rate or that it's going to a very low level from here. It's just reassessment of the U.S. economy versus the rest of the world.
But is it a reassessment for asset allocators too, Kathy? Because usually when bonds gain, you also have this sort of insurance property of the dollar where it strengthens alongside of that, especially if we're in risk off. For an international investor, does it now make more sense to take a second look at your own local bond market instead of coming to the U.S. if we are looking at a dollar weakening trend starting to take hold?
Yeah, absolutely. The strongest performing asset class in fixed income year to date is international developed market bonds. So they have proven attractive. Most of that's driven by the weakness in the dollar. And I think now, after 10 years of not really finding much value in other bond markets, given the dynamics, I do think that investors would be well advised to consider some allocation outside the U.S. in the developed market bonds. I'd be a little careful about emerging markets. They're kind of the victim here in this global trade war. That could be problematic for them for a while. But in terms of allocating, I would expect to see more allocation to other bond markets by both U.S. investors and foreign investors.
Kathy, among all of the data, all the earnings we get this week, we're also going to get the Treasury's refunding announcement. That comes on Wednesday with Treasury Secretary Scott Bessent putting that into the market. We all remember the summer of 2023 when it was enough to shake the market. How fragile are we going into this? How important will the refunding announcement be?
I think the expectation or the nervousness is already in the market right now, so I don't expect any huge surprises. It's proven to be the case so far that Treasury Secretary Bessent has followed Janet Yellen's formula pretty closely, despite his criticism of it. I don't think he'll reach to try anything new at this stage of the game because, the dynamics haven't changed. Nothing's really changed in terms of the way the Treasury needs to fund itself right now. We do have the whole debt ceiling thing that's still sort of hanging over our heads. So there's limited room for the Treasury to do anything new. with the refunding announcement. It could weigh on the market a bit just because people will look at the supply coming and amid all the other uncertainty. But I don't think it's going to shake up the market too much. We've already gotten shaken up for various reasons. I'd be really surprised if Treasury Secretary pulls anything new out of the hat right now.
Yeah, this is a market that's definitely coming out of a period of some big shakeups. Kathy, thank you so much for joining us ahead of a busy week. At least we have some quiet for now. Kathy Jones of Charles Schwab. Let's get you some other top stories now that are trending on the terminal. Pressure ramping up in the Panama Canal. China is dialing up the scrutiny of Hong Kong billionaire Li Ka-shing's plans to sell Panama ports to a group backed by BlackRock. Chinese regulators say the deal can't happen without their approval. At the same time, President Trump is calling for free-of-charge passage for U.S. ships. President Trump's popularity is sinking. Polls from NBC, CNN, ABC, Fox, and the New York Times, among others, show that voters think he's falling short of core campaign promises to strengthen the economy. The president marks his 100 days in office on Wednesday. And fast fashion giant Shein hiked prices across products in the U.S. by as much as 377%. Most of those hikes came on Friday. Shein and other commerce platforms face an 120% tariff after the U.S. ended the de minimis exemption for small packages from China and Hong Kong. Coming up, it's a big week for big tech. For the Mag 7 names report this week, what to watch from their results, we have that next for you on your Bloomberg Brief.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
They want to make a deal, obviously. Right now, they're not doing business with us. You know, people talk about going cold turkey with China, meaning just forget about it. We were losing hundreds of billions of dollars a year with China, and now they're not doing any business with us.
President Trump speaking in New Jersey about the trade impasse with China, by the way, reiterating this morning that the two sides are not talking. The trade war is expected to cause a supply shock for the U.S. economy. Joining us for more is Bloomberg Global Business Editor Josh Galoo. Josh, we've seen reports that shipments coming from China have dropped as much as 60%. It seems like we're getting close to the actual pain of tariffs starting to show up on the shores.
That's right. With cargo shipments falling that dramatically, we're really on the cusp of seeing the impact of these tariffs, beyond market reaction, which we've seen ever since they were announced. This is where it's going to hit consumers, and we have both economists and also retail leaders suggesting that if nothing's done, that this sort of disruption is going to cause empty shelves, the kind that we saw during the pandemic, and massive price increases. That is when the rubber really meets the road for Trump, because these are going to be his constituents who are going to really directly feel the pain from these tariff wars. At the same time, we have retailers like Temu already increasing the prices significantly on their smaller items that come from China. The U.S. decided to end the de minimis exemption for $800, and that happens immediately now. We've seen the price go up by factors of 3 for some items. So this is really, we've now reached the point where the impact is going to be felt by consumers, by voters, and we're seeing that also in Trump's poll numbers, that the pressure is starting to pick up.
But there was relief in the market last week, Josh, on this idea that Trump was ebbing his most extreme rhetoric towards China in terms of tariffs. Has there been any movement with negotiations on either side?
China says no. And the Trump administration has done little to suggest that that is incorrect. They reiterated that today, saying that talks are not ongoing, as a matter of fact. And when the Trump administration has suggested that there's been progress, they've indicated that it's been at a pretty low level, and it's unclear exactly what's happening there. At the same time, Treasury Secretary Bennett has been towing the line that Trump has held, which is suggesting that China will be forced to come to the table because he says their economy is so dependent on selling inexpensive goods to the U.S. So that's also an indication that the talks are still at mostly a standstill, if not completely.
Okay, Josh, thank you so much. We'll see if there's any other developments this week. Bloomberg's Josh Galoo. Now, elsewhere in corporates, Airbus has agreed to take over some assets and sites from Spirit AeroSystems. It clears the way for the struggling U.S. aerospace supplier to be reacquired by its former parent, Boeing. Joining us now is Bloomberg's Benedict Campbell, who leads our global aviation coverage. Benny, this has been floating around for some time. Why now?
Well, it's an incredibly complex deal. It was announced last year, in July of last year. Boeing said that they would reintegrate Spirit AeroSystems. This is an asset that used to be part of Boeing. They spun it out in 2005, so almost 2 decades ago. Well, actually, exactly 2 decades ago. And then had to, when they were in deep crisis, last year, had to essentially take the uncomfortable step of taking that business back to gain greater control over the quality, over the finances of this business. Where it gets complex is that Spirit not only makes parts for Boeing, but also parts for arch rival Airbus. So Airbus obviously didn't want to see that part of the business be reintegrated into Boeing. So what started was the long and drawn out sequence of sort of unpacking Spirit, moving the Airbus parts back to Airbus, keeping the Boeing parts with Boeing, and what we saw today was step number 1, Airbus essentially taking over facilities all over the world, really. There are some in Scotland, there are some in Belfast, in Ireland, there are facilities in the US, in Asia. So really all over the place, making parts from the A350 wide-body aircraft all the way down to the A220 single aisle. And Airbus is actually being paid to take over these components, and that gives you a sense of just what kind of financial distress Spirit is in, and that it was high time that it came under new ownership again.
So with Spirit in hand, what sort of advantage or what sort of improvement does Boeing realize, Benny? How much of a game changer, or maybe even not, will this be for Boeing?
Well, it's sort of a value-destructive deal to begin with. They didn't do this because they wanted to. They really had to do it because they were in crisis. Spirit was in financial crisis, but also in a production crisis. If you remember at the start of last year, that door blowout that we saw, that was a fuselage that was built by Spirit and clearly had some very eye-watering faults on it. And that's when Boeing decided, okay, we need to gain closer control of Spirit, really put them back under our umbrella, both in terms of production but also finances. And that's what we're seeing. So over time, Boeing and to some degree Airbus will gain much tighter control over Spirit, hopefully enhance the quality of the components that come out of their facilities, enhance the financial wherewithal of this company. But that'll take time. We will get the Airbus numbers on Wednesday after the close, after the European close. One of the big questions really to Guillaume Faury, the CEO, will be, what kind of money do you need to pump into Spirit to make it a viable business? The same question will come for Boeing. So this will be a long, drawn-out journey to really return Spirit back to its former self and to give it some strength again.
Yeah, a long journey ahead. Benny, thank you so much. That is Bloomberg's Benedict Campbell. By the way, in the pre-market, Spirit is up 2.6%. Boeing is up 1.6%. It is also a big week for the Mag 7. Microsoft, Apple, Meta, and Amazon, they all released their results in a market affected by a trade war, concerns of a tariff-induced recession, questions over whether CapEx can continue at the same pace that it has for these tech giants. Joining us now with the latest is Bloomberg Charlie Wells. Charlie, what are we looking for in this week?
Yeah, Danny, we're looking for pressure because this is a segment that has certainly been under a lot of scrutiny this year. And these mega caps, the four that are reporting this week, have a 20% weighting on the S&P 500. So the results could have an outside effect on the broader market, not just on their specific shares. And actually, I said pressure, and that's because there's already been a quite high bar set by Alphabet last week. Everyone was wondering how those earnings would come in, and they actually came in better than expected. So that's giving tech something of a relief, but it also has set a high bar, and any revenue misses from these mega caps could be punished in the market.
A high bar, but at the same time, we are looking at tech down some 15%. Charlie, is some of the bad news already priced in for these companies?
There's a sense that it could, and there's a sense that as long as these firms can actually deliver and kind of stay within their targets, they could ease through or at least make it through this earnings season. Some of the issues, though, to focus on are going to be tariffs, right? We've got Apple reporting, and they are so exposed on that China supply chain. We've got issues, as you mentioned, about capital expenditure, and we also have the issue of ad spend. So Google had better than expected ad revenue, and that could kind of spell better than expected news for the likes of Meta, which is also highly reliant on this ad spend. So in some ways, these mega caps are not necessarily bellwethers for the entire country, but they are bellwethers for the corporate world because they indicate IT spend, they indicate ad spend. So what happens there is going to have broad implications for the market at large.
Yeah, that's for certain. 40% of the S&P market cap reports this week. Charlie, thank you so much. Bloomberg's Charlie Wells. Now, coming up, we're going to get you set up for your week. As Charlie was just talking about, we have a whole lot of earnings. There's also a lot of data for you to get through. It's quiet for now. How long does it last? This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Let's get you set up for this trading week. On Wednesday, President Trump will be marking his 100th day in office. Then Meta and Microsoft, they'll report their results on Wednesday. Amazon and Apple, those come on Thursday. Then we're going to wrap up the week with jobs report on Friday. By the way, before that, we also get GDP and PCE. Now, some individual movers this morning. NVIDIA weaker, less than by just about 1%, actually exactly 1%. There's that Wall Street Journal story over the weekend that Huawei is testing a new chip to rival NVIDIA's. Boeing, it's also rising. Bernstein has upgraded it to outperform, citing that it's now making progress on the need for its growth trajectory. They're also going to be buying Spirit Aerosystems, or closer to that. Domino's Pizza up just 1/3 of 1%. It's going to be reporting earnings before the bell. Now, coming up tomorrow, one to flag for you on Bloomberg, our exclusive interview with the Goldman Sachs Chief Executive, David Solomon. That will be happening right here, 5:30 a.m. Eastern, so come back for that. But a quick check on the markets as we head to the end of the hour. The S&P 500, little change to slightly lower this morning. That is it for your Bloomberg Brief. Surveillance up ahead. This is Bloomberg.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum. the Sheikh Zayed National Museum. There you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Short-term volatility that then can resolve itself. The concern is if we cannot have some certainty in the markets.
These markets are looking for certainty, they're looking for direction.
The U.S. markets are still the most liquid and the deepest.
Nothing is safe. Everything is a risk today.
This is not the time to get out of the market, right? You need to play this out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday as the president attempts to shift the focus from tariffs to taxes.
We're going to be taking in a tremendous amount of money, and we're going to make a lot of money, and we're going to cut taxes for the people of this country. It's possible we'll do a complete tax cut, because I think the tariffs will be enough to cut all of the income tax.
The White House looking to put the spotlight on tax cuts as the Treasury Secretary Scott Bessent plays down the recent turmoil.
I've been in the markets for 35, 40 years. Anything that happens over a 2-week, 1-month window can be either statistical noise or market noise. And we're in this for the long term.
Investors turning their attention to the data, earnings from Microsoft, Meta, Apple and Amazon, and a read on the consumer, manufacturing and the labor market. Can this economy escape the volatility unscathed?
And another way of asking the same question, which is exactly the right question, is can earnings, economic data, and a Treasury refunding announcement overwhelm the whipsaw of headlines that has to do with tariff announcements that we've been getting, which has led to this uncertainty level that people have not experienced? We have 40% of the market cap of the S&P 500 reporting earnings this week. We have the jobs report, we have the JOLTS data, as well as ISM survey. Can that be enough to give some certainty?
And we're coming off a 4-day winning streak on the S&P 500, totaling more than 7%. How credible is this rally if we don't know how credible the talks are?
Well, the Treasury Secretary said he wasn't aware, he wasn't sure if Xi Jinping and Donald Trump got on the phone. Marco Rubio was also on the Sunday show, Secretary of State. He said that he's not going to comment on any negotiations that might be taking place or any phone calls. So it doesn't sound like the two actually got on the phone, because if you were going to call the Chinese leader, you would think your Treasury Secretary and Secretary of State would also be privy to the call.
We've had a lot of warnings from corporate America in the past week or so, from the retailers to the White House, from the airlines to investors. Southwest, brutal in the last week. Just saying it out loud, this is a recession.
So this to me is a real question. How much, as we get 40% of the market cap of the S&P 500, do we get the ultimate check? Because these are companies that range from, yes, the Magnificent Seven, as well as a whole host of different consumer-facing companies. We get McDonald's, we get Starbucks, we get Hershey's and Mondelez. We also get the oil majors. We get a lot of different sectors of this economy. Does that have more of the check on President Trump that a lot of people have been looking for than, say, the stock market or even any volatility in the bond market?
We mentioned payrolls on Friday. The estimate on Friday, a sneak peek in our survey, 130. It's not a bad number. Still expecting a decent number on Friday. That's the hard data, 130K, the median estimate in our survey. Coming up this hour, we'll catch up with Lori Calvasina of RBC, with stocks looking to build on a 4-day winning streak. The former senior Trump trade advisor, Kellyanne Shaw, as the White House looks to iron out trade talks, and Christian Keller of Barclays on the potential impact of tariffs on U.S. growth. We begin this hour with stocks steady ahead of a busy week of results from big tech. Lori Calvasina of RBC writing, what we need in earnings call transcripts keeps us in the camp that recession is not a foregone conclusion, and makes us concerned that any adverse impacts from tariffs may be felt a little later in the year or even next year. Lori joins us now for more. Lori, good morning.
Good morning.
We've had quite a rally in this equity market. I'll ask you the question I asked at the top of the program. How credible is the rally if we're not sure how credible the talks are?
So look, I think we all have to pull in our time horizons a little bit. So as much as we would like to do things on a 6 to 12 month view, there's just not the visibility for that right now. If you take a shorter term time horizon, I've seen enough in my data to suggest it is reasonable for the equity market to try to make a stand in here. So when we went to the April 8th lows, it was an 18.9% drawdown, very similar to the drawdown of 2018, very similar to the drawdown of 2011. So we kind of bottomed out in growth scare territory where we're not pricing in a recession or crisis, but we really did have fear that one was coming. If we look at the Michigan data, if we look at AAII net bulls, you're basically at rock bottom levels, right? So from a contrarian perspective, there's really nowhere to go but up. That being said, other indicators have more room to fall. So if we look at the rate of upward revisions, it's been about 28% to the upside. That's about as bad as you need to be in a non-crisis or non-recession type environment. But if there's another shoe to drop, that's going to 10%. I will say that my team and I sort of huddled up on Friday. We got deluged by earnings. We've been griping about how we're not getting enough information. We got what we wished for, unfortunately, and we had a lot to sift through. And as I was talking to my team, I said, what's your gut feel on how this week went? And everybody said, it really didn't sound that bad, considering the setup. And I think that's the answer. It could have been worse, and companies did let us know that they're on the case. It's going to take some time. There's a lot of intellectual honesty that came out last week.
If April ended today, consumer discretionary would be positive on the month, which is kind of shocking, right? The consumer discretionary would be positive on the month, given all the headlines we've seen. Does that make sense to you?
Well, look, I do think that consumer discretionary stocks are where there is going to be value unlocked in this market. I think tech is another place. Now, I don't think that we've necessarily, kind of gotten, to that neat and tidy bow in my work, so we're still neutral on that sector. But we have been saying over the last month or so, consumer discretionary stocks are cheaper in small caps. Small caps are cheaper generally. So if you want to bargain hunt, that's a potential place to kind of look down cap. You have to have a lot of long-term patience. But, I think that when you go into these kind of crises, on the one hand, you have to play defense, right? But I don't like a lot of defensive sectors. So I sympathize with people who are trying to look for the other side. I just caution people, things may have to go down a little bit more before they go up. Any seasoned investor knows that's how you treat these environments.
There's a tricky theory out there that a lot of people have brought forward a lot of their purchases to get ahead of tariffs, and that's what we're seeing in the data. It's more robust than otherwise would be the case because of that. Is that your experience when you dig into the earnings and you look at the line items?
Yeah, and we've at the end of, I would say, like March, early April, we stopped only just looking at S&P earnings call transcripts. We started reading across the Russell 3000 and looking at conference transcripts as well. And so we got a lot of good color on the consumer from then. And so what I'm seeing generally on consumer, again, this isn't just big cap earnings, but all the consumers are getting hit, right? Like you're not sort of seeing high end is strong, low end is weak. It's kind of like the consumer is getting hit broadly. The high end seems to be trading down. So that's one thing we're hearing. But, I was laughing last week because I read a bunch of the telecom companies, and I was laughing because we did buy an iPad for my 4-year-old because we know his is about to die, and we don't want to deal with that. And I mean, just being honest here. And so, but I was laughing because the telecom companies are all talking about how mobile devices were pulled forward. And so we were exactly part of that consensus in my household. On the other hand, you are seeing, some of the home improvement companies, right, talking about big ticket items being delayed. And so there's kind of both going on, right? People are pulling forward some purchases that they know they need to have for one reason or another, and things that might be a little bit more discretionary are being pushed out. So, how is it all going to shake out in the end? It feels kind of like a muddle through. But that pull forward of demand, I do think that's going to have consequences later on.
John just mentioned that it's more than 7% rally in the S&P over 4 trading sessions, this massive rebound. That leaves the S&P less than 3% below where it was on April 2nd. That's sort of shocking to me, given the fact that actually, even with the delay, you're talking about higher baseline tariffs of 10% plus the sectoral tariffs than even what was expected as the base case heading into this. Does that make sense to you?
It actually kind of does. And, we're still well off the highs. I was talking to a colleague over the weekend. I think we're still, he did this math, not me, but I think we're still like 10% or something below the highs. And he's like, well, we're baking in a garden variety pullback. I'm like, no, not quite, because we went down and had growth scare territory. So we're rebounding from that. But I'll tell you, Lisa, my valuation and earnings work, we redid all this right after the Rose Garden. We put a stagflationary scenario in. So we put 0.5% of GDP, mid-3s on inflation. One model uses PCE, the other uses CPI. CPI. We cut margins, sort of similarly to the cuts or the deterioration in margins we saw back in 2018. And we did a few other things as well. But what we saw at the end of the day, I got to 258 on earnings. I got to a trailing PE of 20.7 times. And if you do that math, it takes you to 53.51 on the end of the year at the S&P. We always say this model is kind of a compass, not a GPS, but it's telling me that we're sort of fairly valued if we're looking at stagflation. If we have to price in recession, there's another leg lower. We're not going to do 18.9 on the downside. We're going to go down to like 4,500 on the S&P, and I'm going to have to redo all the models. But I think if you assume we kind of muddle through this year, it's kind of reasonable to be where we are right now.
Lori, if we muddle through this year, when will the tariff impacts actually hit?
So it's interesting. I've been watching this on the consumer, just the consumer companies, the industrial companies. I think they have the best read. And it seems to me, especially on the industrial side, there's been enough demand pull forward and planning, and there's sort of stickiness in pricing. It depends on which company you're reading, but generally I'm seeing a lot of people who are saying, look, we're going to be able to get through the next couple quarters. We've gotten through where we are okay. Some companies are saying more second half of 2025. Other companies are saying more 2026 impacts. It's somewhere down the line. I go back to 2018, and what I remember very, very clearly was that there was still optimism on tariffs that went through the summer. We could see this very clearly in small cap pricing and small cap positioning. It was a buy the USA trade. We're going to be resilient. That all fell apart after Labor Day when the street started having their conferences and companies came out and said, oh, no, this is going to be a problem. And you started having hints of discussion for the following year. Some companies are saying right now it's going to take them more time to really give good guidance. So we really have to, nobody should go away in August, and nobody should certainly go away in September.
Oh, come on.
And people, no, I mean, I'm sorry, I hate to but you got to do the pre-work in August to get ready for September, because we all need to be out at conferences listening to what companies are going to say.
Lori, thanks for that. You're going to stick with us. Bonus round. Lori Calvasino of RBC. What a start to Monday. What a start to the week. Don't have a summer. Don't take any time off. Don't take a vacation. Cancel the trip. Southwest, apparently that's already happening, according to that airline. Equity futures at the moment, just a little bit softer. No real drama here. We're down about 1/10% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hakes. Hey, Yahara.
Good morning, John. President Trump floated a new income tax cut in an effort to ease the pain Americans could feel from the tariffs. In a post on Truth Social, Trump suggested that tariffs would help him reduce income taxes for people making less than $200,000 a year. He's previously argued that tariff revenue could replace income taxes, though economists have questioned those claims. Meanwhile, Treasury Secretary Scott Bessent said trade talks with Asia are going well. He said countries including South Korea, Japan, and India are leading the way in tariff negotiations, and that some nations are prepared to make significant concessions to secure a deal. And Chinese e-commerce company Shein has raised U.S. prices of its products ahead of tariffs on small parcels. The price hikes varied by category, with beauty and health products increasing by 51% and certain kitchen towels by over 370%. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later on in the hour. Up next on the program, the president shifting the focus.
We're going to cut taxes for the people of this country. It'll take a little while before we do that. I think the tariffs will be enough to cut all of the income tax.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall down in Washington, D.C. and get you more from Lori Calvasino of RBC. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Good to be back in New York City. Welcome to the program to you all. Live this Monday morning with equity futures slightly softer on the S&P, down by 0.2%. Coming off the back of a 4-day winning streak on the S&P 500, the longest since the start of the year. Lots of earnings this week on Wednesday, Meta, Microsoft, Thursday, Apple and Amazon. In the bond market, your bond setup looks like this. Bond yields on a 2-year, 10-year and 30-year, just a little bit higher, up by 2 basis points on 2s, up by 3 on 10s. Your 10-year, 426.42. Looking for some hard data, you'll get that through this week, including payrolls on Friday. 130,000 is the median estimate in our survey. Going into that, your 10-year, 426.42. Under surveillance this morning, the president shifting the focus.
We're going to be taking in a tremendous amount of money. We're going to be taking in a lot of jobs, a lot of plants and factories. They're already coming. I mean, you see it. And we're going to make a lot of money, and we're going to cut taxes for the people of this country. It'll take a little while before we do that, but we're going to be cutting taxes, and it's possible we'll do a complete tax cut, because I think the tariffs will be enough to cut all of the income tax.
So here's the latest this morning. President Trump suggesting tariffs would allow him to reduce income taxes for people making less than $200,000 a year. A CBS News poll showing approval for his handling of the economy falling to 42% this month from 51% back in early March. Joining us now to discuss Bloomberg's Tyler Kendall. Tyler, pretty aggressive effort there on the taxes.
Yeah, hey, John, good morning. Well, it's because this White House is really banking on its tax cut agenda to get more cash into consumers' pockets and quickly. Now, economists have raised questions about the feasibility of what President Trump is suggesting here, using tariffs as a revenue raiser to perhaps potentially completely offset income taxes, mostly made complicated by the fact that these tariffs actually aren't codified by Congress, but lawmakers in Congress are actually returning today to Washington to start crafting that reconciliation package that will get done these tax cuts, but they do need to find some more pay-fors if they want more tax cut priorities to be included, because they're currently working off of the Senate budget blueprint that includes about $5.3 trillion in net tax cuts, and that's likely enough to make permanent that 2017 tax cut plan, and actually could include some other tax priorities. The thing is, there's just so many of them currently on the table, including no taxes on tips, overtime pay, Social Security, not to mention President Trump floating that he would like to see the corporate tax rate cut to 15% for those companies that make their products in the U.S. The thing here, though, is that last one likely won't be prioritized because Republicans are really trying to reassure their constituents amid this tariff fallout. We talked about those polling numbers at the top there. Treasury Secretary Scott Bessent was actually asked about them over the weekend in an interview. And John, he really downplayed concerns, saying that he, too, is actually watching the data when it comes to this. He pointed to consumer spending, which we know was up last month, but came in much weaker than expected as we look ahead to later this week as we get all these other numbers coming through.
Tyler, when it comes to the tax bill, what's the timeline?
Well, Anne-Marie, the White House wants to see it done as soon as possible, and some allies in President Trump's circle would like to see it done by Memorial Day. That's considered to be a very ambitious goal at this point. What could potentially add some fuel to the fire here is that we are waiting for a firmer X date to come out from the Treasury Department, and that could potentially really spur lawmakers to work a little faster because we know that Congress likes a deadline. It really, though, remains to be seen if they can get this done on a more expedited effort. Many estimates put this much much later into the summer, potentially early fall to actually get it done. Because we have to keep in mind, it's not just the tax cuts that they're trying to talk about here. There's also big disagreements when it comes to the chambers on spending cuts, as Republicans really are raising these concerns about potentially what this bill could mean for Medicaid. We could get potentially some headlines later today. We do know that House Speaker Mike Johnson is meeting with President Trump at 2 p.m. Eastern, and no doubt this is going to be a big priority.
Tyler Kendall down in Washington. Tyler, thank you. This would be aggressive. It was the only thing they had to do, but it's not the only thing they've got to do. There's a pretty aggressive trade timeline as well. Just getting a headline from Japan that the chief trade negotiator will travel to the United States between Wednesday and the end of the week. So Japan's in the mix, and a whole bunch of countries are in the mix pushing for the same thing.
The Treasury Secretary over the weekend talked about 18 countries that potentially they will have this deal with. And then he did caution and say, look, deals can take months, but we need blueprint. He says it's a process in place. So he sounded very optimistic that barring China, within the 90-day reprieve, they're going to get a number of these blueprints out at the door. But he's also the individual in the administration up in Congress, and he'll be back in Congress this week, meeting with Speaker Johnson, meeting with Majority Leader Thune to try to get this tax bill as well across the finish line.
With us around the table to continue the conversation, Laurie Calvasina of RBC. Laurie, let's start on taxes. Do you consider this a removal of a potential headwind or providing a potential tailwind?
So to me, it was more of an issue for last year as opposed to an issue for this year. I think there was a big, distinction between the two candidates, that one wanted to extend the tax cuts and the other didn't. And so I viewed one of those as equity market positive and one of those as equity market negative. I don't have the same, sort of assumption about this year, right? I think we want to get this done from an equity market perspective. I think that's important. But I do think it's gotten a lot more complicated, right? I'm sort of listening here about all these things they want to do. Tariffs are in the mix. Tariffs are going to pay for it, but tariffs aren't codified into law. I'm certainly not an expert on the legislative process, but I've done this enough over the years to know that there are rules and procedures that have to be followed, and the math does kind of have to balance. So I'm really confused how they're going to get this done by the summer. Back the last time they changed taxes, I think they signed the bill in December, and so that's what I've been telling my clients to prepare for, that it's going to be a long negotiation. There's a lot of uncertainty. I think they're going to get the extensions done. I'm not so sure beyond that if we're really going to get anything that's that exciting. And it just doesn't have the same excitement factor for me this year. It's avoiding a negative as opposed to enacting a positive.
Well, when it comes to the revenue-raising tariffs, how are they going to be revenue-raising if Scott Bessent is in the middle of negotiations with all of these countries?
Right, and I think the other thing is the efficiency, measures that are being taken down by DOGE, right? My sense is that those have not come in as high as initially anticipated either. So I'm just kind of wondering where all the money for this stuff is going to come. And then we go back to the bond market, and I'm not a big person on the deficit, in terms of my own research and own focus, but I know that there are those people out there, and we hear from them a lot, and I can't imagine that kind of cutting taxes when you don't have all this security on the revenue side is going to make those folks happy.
Oh, no, especially not the House Freedom Caucus, which Mike Johnson is going to have to get on board if they want to get this across the finish line. So it sounds like this is just an extension of policy. But for your base case, if they were to add in one sweetener, what do you think it's going to be?
What I keep kind of going back to is, sort of getting reshoring back in the U.S. And I have been seeing a few companies allude to the idea of maybe doing that through tax incentives. And, to me, when I think about how you're going to get that going, the idea of sort of the carrots, right, I think is really intriguing. And so I go back to that debate initially, kind of around the election of 15% corporate tax rate for domestic production. That debate, right, seems to have kind of faded into the background. But do we get some incentives? So if you looked at Bessent's, speech in New York, I think it was it last month? Time is morphing in my head. But when he made that speech to the Economic Club, he talked about expensing for factories and some, business-friendly stuff there. Does that kind of stuff come in? I think that could be really interesting from an equity market perspective if it does.
You dismiss the deficit aspect. A lot of people in the bond market wouldn't. They would actually prioritize that. And there is a sort of ultimate check on how much deficit spending this Congress can do at a time when there are some questions around, yes, people will fund the U.S. deficit, but at what price, given where yields are? How much is that a concern for you, that there is that limit on how much they can do the sweeteners based on what the response will be in bonds?
Well, I think it's, it's interesting, right? It's when the deficit conversations come up in my meetings, and I tend to talk mostly to equity PMs who have been more interested in things like Doge because of the opportunities it can give to IT companies for spending on software, right, and things like that. And so there's just a different focus, and there's just a different, sort of time horizon, frankly, where we tend to be looking more on a 6 to 12 month basis as opposed to longer term. But if you start to see problems in the bond market because of this issue, it will back up into the equity market, and it'll have an impact on our valuations.
Do you have a sense at which it's the danger zone if you see Treasury yields hanging in a certain place, especially with weakening growth, where all of a sudden it's sort of a warning signal that maybe the bearish outlook is more relevant than the bullish one?
So it's tricky right now. If I look at my earnings yield gap model, you have to adjust both your assumptions on the bond side and the PE side. But if we just look on sort of the bond side, the testing that I've done in my work suggests 5% is really the problem. So we haven't made that approach yet, but when we've made that approach in the past and it sort of looked like things were breaking in that direction, that's when equity markets have really gotten some indigestion. So my guess right now is that would still be kind of the marker. I think the other thing I see on the data, and I'm not a technician, but if you were to hit 5% on the 10-year Treasury yield, we're no longer sort of bobbing around, right? We're in a structurally rising rate environment, and I think that changes a lot of modeling that's done on the street.
Can you help us prepare for this week? Full of economic data, jobs tomorrow, ADP Wednesday, claims and ISM on Thursday, payrolls on Friday. I keep reading note after note that says this market will respond more to a weaker print than a stronger one. Is that your playbook for this week?
So, I would look ahead to the NFP data, to be honest, because I didn't even put the Michigan survey on the front page of my report last week. I'm just so tired of talking about the soft data at this point. We all know what it says. We all know how everybody feels. We've just got to see when this actually reverberates in things like earnings and payroll and also, just in the GDP data. And I don't think we're going to really see, my gut is I'm not an economist, but I'm not really so concerned anymore about 1Q GDP, whatever knocks we hit. Yep. We're gonna deal with. It's really about what are the knocks going forward. But I do think it may just still be a touch too early to really see any kind of impacts in hard data. That's
Seems to be the consensus going into Friday, that's for sure. And I think a lot of people are fed up with you, Mitch, as well, so you're not alone. Laurie, it's good to see you, as always. Thank you. Laurie Cavacina of RBC. Just a note for you, just briefly, just moments ago, The Atlantic publishing an interview with the President of the United States, Donald Trump.
They're talking about trade yet again, and Trump is saying there's no red line that would change his tariff policy. Quote, it always affects you a little bit, but there is no red line, no certain number. And this gets back to the question I asked him on Air Force One, which initially he said was a stupid question. And then he said, I don't want to see anything in the market go down. When I asked him, sir, is there a Trump put? Doesn't sound like there is.
Equity futures just a little softer. No drama at the moment. We're down by 0.25% on the S&P. We'll continue the trade conversation in just a moment. We'll be catching up with the former senior Trump trade advisor, Kellyanne Shaw, as the White House works to iron out trade deals. And the timeline is very aggressive. That conversation's up next. From New York City this morning, good morning to you all. You're watching Bloomberg TV.